For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from the nation's capital this morning. Good morning to you from the IMF World Bank headquarters. The conversation's continuing here down in Washington, D.C. Gita Gopinath coming up a little bit later. I'll run through the guests you need to look out for in just a moment. Let's start with the price action and get you started with the equity market. Equity futures on the S&P 500 shaping up as follows. Positive by almost 0.1% on the NASDAQ 100, up by 0.2%. Quick snapshot of the bond market. 2s, 10s, 30s look like this on a 2-year yield, higher by a single basis points. Still just in and around 4% on a 2-year. Holding that range at the moment, 397.25. The range last week, though, wide. We traded in the 360s at one point off the back of weaker than expected data, then repriced off the back of payrolls, then repriced again the other way off the back of CPI. And Lisa's got tons to say about that, and I'm sure she'll share it with you in the next 10 minutes. At a 10-year right now, 342.43, yield higher by 3 basis points there. And let's just finish with foreign exchange. Euro dollar, the euro against the US dollar, shaping up as follows. 110. Back at 110.
There it is.
110.18. We're positive 0.2%. A stronger euro really in the mix, TK, over the last couple of weeks again.
This is a backstory right now, and I really want to set this up for our next guest, John, but the bottom line is there's this beginning of a significant dollar weakness. As we talked to Ibrahim Mabari yesterday, the idea of euros through 110, 115, a few brave enough to go to 120, and Jordan Rochester looking at sterling that changes. I mean, you're not going to be able to buy the tots if this.
Oh, we're buying the football club now.
We're looking at it.
Okay, good to know. I'm going to jump in with some earnings.
I don't know if we want it the way they're playing.
I don't think we want it either. Maybe we'll get it on discount this summer. I want to talk about the airlines just briefly.
Yeah,
I know. American Airlines out with some numbers that didn't impress investors just yesterday. Delta out this morning, saying that they see second quarter adjusted EPS at $2 to $2.25. The estimate, Lisa, 161. I know you've got a little bit more. The number in a pre-market, the stock is up by about 1.2%.
Yeah, popping after basically keeping their full-year adjusted EPS around $5 to $6 versus the estimate of $5.37. Here's the issue. Delta has continued to see very strong revenues and very strong passenger volumes, although definitely coming off just a little bit. If you take a look at the first quarter passenger revenue, it's about $10.4 billion versus the estimate of $10.56 billion. So really it is that the margins are better. And this really has been the story that we have continued to see with airlines. As I'm just saying out loud, sometimes you find that service might not be the same and you get less and you pay more. So potentially they're actually getting more in the profits area.
Not talking about Delta in particular, just the broader airlines.
100%. No, it is. I mean, when you go, it's, there's always like small cutbacks in service.
Their margins are a problem.
I mean, their margins are small discomforts.
Yeah, they're all turning into Ryanair, Tom.
There was a fist fight.
Packing you on the
I was on a flight. I was on a flight recently, not Delta. There was a fist fight in economy because they wouldn't take the charge card or the cash for the beverage of your choice.
Oh, right.
They got some digital setup thing. They're milking everything they can. They're back in row 42 milking a $6, little teensy.
I'm just
little
guessing that
bottle
you
of
weren't
something.
sitting in row 42. I'm just going to throw that out
Well,
there.
I will also point out that they have now new rules where they won't serve drinks up to a certain point in the ride because of behavior like that, because people are getting a bit
I
more
thought you were going to say because of people like Tom.
I wasn't going to go there.
Coming
Going
up,
downhill fast.
I'm going to share with you
don't
what's
know,
coming
it's
up a
probably
little bit
on the
later
Gulf
this
Stream.
morning. Extended version of Bloomberg surveillance this morning, so we'll go through to about 9:56 Eastern time. For those of you who want to be really precise, 9:56:30. David Malpass of the World Bank's coming up. Gita Gopinath of the IMF. Paolo Gentiloni of the European Commission. Raghu Rajan, good friend of this program over the years, Tom, of the University of Chicago Booth School, and formerly, of course, ran the Indian Central Bank as well.
And leading us with the expertise right now, Jennifer McCowan-Jones, Chief Global Economist, Capital Economics, and of course, formerly working with the Bank of England. Jennifer, the governor of the Bank of England is looking out there to declare victory. Can England, can Europe declare victory if many are modeling stronger sterling and stronger euro?
Well, no, I don't think so. Given that inflation, clearly, from the Bank of England's perspective, inflation is still far too high. Headline rates coming down, but core not really. And that's got to be the major concern. They really can't declare victory until that's under control. And I think what's happening really is that whereas recession risks previously were focused more on Europe, given the energy crisis, now we're shifting to a different set of risks around banks and around credit, which are affecting economies more broadly, and the US now more coming into the mix in terms of recession risk. So I think really it's not about good news on the European economies, but more about bad news on the US.
Jennifer, I'm going to be clear. Britain seems to be off the radar here. The president in Ireland yesterday with the prime minister. All that is fine, and there's a very EM focus here, a banking crisis focus, China, the US. From where you are, with great respect, has Brexit been successful?
Goodness, I don't think we could say that at this stage. Exports are really not faring well. One difficulty with any analysis of Brexit at the moment is that so much has come along in the meantime in terms of the energy crisis, now banking turmoil. It's very difficult to strip that out and to know exactly where we stand. But certainly it is causing us problems, not least in terms of labour supply and labour availability, which is still a major issue in the UK, and one of the things that's driving up wage growth, creating problems for the Bank of England.
Well, we got some data this morning about GDP in the United Kingdom, and we got a sense of really strong stagflation, and the UK really underperforming other G7 nations for a protracted period of time. What is that period of time, and how soon will other nations join, or is it really going to be about the UK emerging from this into something perhaps a bit better?
Yeah, well, I think actually the February GDP data surprised us a bit on the upside. It wasn't quite as bad as we'd expected. We'd anticipated a contraction. And it now looks actually like in Q1 as a whole, the UK economy will have grown, which is something of a relief. But that said, I think things are going to get worse. The UK is going to head into a recession, probably from the second quarter as credit conditions tighten. And I think, unfortunately, other economies are going to join it. This issue of tightening credit conditions is broad-based. The slowdown in lending has been much more pronounced in Europe than in the US so far, where lending growth is still holding up very well. But I think it's going to spread, and we're going to see the lagged effects of monetary policy tightening pushing economies into hopefully relatively modest recessions as the year goes on.
Will that be enough to bring inflation down, Jennifer, given that some people argue that a lending reduction, a credit crunch, isn't enough always to really create price stability?
Yeah, it's really hard to say. Our assumption is that yes, it will. And we've seen some encouraging signs in the latest US CPI release, rental inflation in particular, starting to come off at last. But there is a real risk here. We're still in the midst of a lot of strike action protests in the UK to try and push wages up and deal with the cost of living crisis, which of course will only extend the period of high inflation, high core inflation inflation in particular. So it's a very difficult position. It's very difficult to judge just how quickly inflation will come down. And we have been disappointed that the disinflationary pressures haven't fed through sooner. But certainly goods shortages now seem to be a thing of the past. And with recessions taking hold, I think it is very likely that inflation will come down much further.
And Jennifer, if inflation comes down, what does real growth do? Does it come down as well, where we have a collapsing of two components?
Yes, probably. As I said, we're expecting most economies to head into recession, so it will probably be the case that real growth is going to dip into negative territory. But the fall in inflation, of course, will bode well for the future. Assuming that we can get core inflation down, then monetary policy should turn relatively quickly. We're expecting before the end of the year in the US, probably not too far into next year in the UK's case, and that will offer some real respite in terms of real growth when monetary policy tightening cycles reverse.
Jennifer, thank you for your perspective. Jennifer McKeown there of Capital Economics on the global economy and on central bank policy too. We mentioned Hermes a little bit earlier in the programme. LVMH as well, Tom, some of the luxury players. Let's just talk about LVMH just briefly. These numbers are phenomenal. So luxury goods unit, Tom, fashion, leather goods, all of that stuff, rising 18% in the first quarter. Their sales up 18%, almost double what analysts were looking for. And on the way into IMF HQ this morning, you and I shared a ride, and Tom was talking about the growth in Japan. Let's talk about these numbers. The regional breakdown, Lisa, just stunning. Japan, the strongest quarterly growth, rising 34% on an organic basis, followed by a 24% uplift in Europe and a 14% jump in Asia, ex-Japan. Those numbers are pretty phenomenal, Tom.
I would say we talk about two Americas, maybe we talk about two globes here at the International Monetary Fund. There's an aspirational, not elite, but just aspirational, striving global audience that's looking at this stuff. I was in the Gucci in Venice years ago, and there was a guy next to me in the counter holding two phones, showing product to people in China. And more importantly, there was a guy over at the other counter doing the same thing. And I mean, this is the global aspirational reach of these products.
So you think it's that the wealthier individuals have more to spend, not necessarily that people are spending more broadly?
I disagree with that. I think it's also some form of middle class reaching up in this time. The media is full of all this gloom and the tangible hardships that are out there. But there's an aspirational middle class coming out of COVID behaving like we've never seen.
So I guess that, and John, I'd love your thoughts. How much is this just us waiting for Godot, waiting for this to stop, waiting for people to stop spending on things? I mean, it's Existential Thursday, so we've got Godot coming up, as always, at 6:45, 7:45.
Can't wait for that.
He's in the 7D, Godot's in
We're
the 7D.
going to be waiting for a while.
I've got a question in there somewhere.
It's amazing.
But I'm wondering
Get there,
whether we're going to end up with basically not coming. People continuing to spend. People have gotten accustomed to spending. We saw with Delta, they are still spending. Bookings are incredibly strong. The second quarter looks great. Are we seeing that trend? And it's not just the wealthiest. It's across the board.
Until the labour market breaks. So that's the number one point, isn't it? It's the labour market. And I think this is what you're speaking to, the resilience of the US labour market over the last 12 months. We had payrolls on Friday.
Yeah.
I know it was the smallest upside surprise, so let me frame it this way. We have not had a downside surprise on payrolls going all the way back to the March report of last year delivered in early April. And this is exactly what Neil Dutt of Renaissance Macro has been talking about for months now. We've been saying the same thing over and over again. It's going to break.
Well,
it's going to break. And Tom, I'll say this. This is why jobless claims has become so important, because Lisa, last week, Tom, we just started to see it break out. Let's see if that continues.
it's edging up. Yeah, there's no question about it. We've formed 1 million jobs in the last 90 days. That's just terrible. It's just terrible.
Coming up on the program, not Godot, Tobias Adrian, the Director of Monetary and Capital
Although he did go to the
Markets
University of Godot.
at the IMF. That conversation coming up shortly.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Fed officials feel they need to do a little more to tame inflation and are leaning toward another interest rate hike next month. That's according to minutes from their March meeting. Now, this despite forecasts from Fed staff advisors that there will be a mild recession later this year. Another missile launch from North Korea. A suspected intercontinental ballistic missile was fired toward waters off Japan's northern island of Hokkaido. Now, that prompted a brief warning from residents to take shelter. South Korea says it's possible that North Korea may have tested a new type of solid fuel missile. There's a report on the alleged leaker of those U.S. intelligence secrets. According to the Washington Post, it's a young gun enthusiast who worked on a military base and shared the classified documents with a group on Discord, an online platform used by gamers. He was known as OG and told the group he spent some time inside a secure facility. Discord says it's cooperating with authorities. Ukraine says it has won an arbitration case against Russia. That would require Moscow to pay $5 billion. It has to do with Russia's seizure of Ukrainian natural gas assets in Crimea, which Russia annexed in 2014. There's been no confirmation from The Hague's arbitration tribunal. And shares of LVMH soared to a record today in France. The parent of Louis Vuitton, Dior, and dozens of other luxury brands saw strong growth in Asia as Chinese shoppers bounce back from strict COVID lockdown. Still, LVMH is seeing a slowdown in the U.S. Global news powered by more than 2,700 journalists and analysts. I'm Lisa Mateo, and this is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
Markets count down in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Forecasts are significantly better than the IMF forecast, but what I should say is that last year we were the fastest growing economy in the G7. We are very confident about the UK's medium and longer term prospects, but we don't pretend that we're not going through a difficult period. Like everyone, we're dealing with very high inflation, which we have to bring down.
Another country that does not share the gloom of the International Monetary Fund. Jeremy Hunt there, the UK Chancellor of the Exchequer, speaking with Bloomberg's Maria Tadeo. You can catch that interview in full on Bloomberg.com and on the Bloomberg terminal as well. UK GDP this morning, Tom, not fantastic, stagnating in the early part of this year, unchanged off the back of strikes, and that individual hoping that things improve from here on out.
You bring up a really important point. How can elected officials agree with Kristalina Georgieva over a 5-year global growth of 3%? He'd be out of his job.
Politics.
Politics.
Secretary Yellen part of that politics this week as well?
Yeah, I think so.
I would think so too.
It's un-American, un-British to follow the IMF line on where GDP's going.
Well, I think it's political suicide to commit to gloom in our future.
Yeah, it is. Well, what do you think, Lisa? I mean, you know.
I think I'm not going into politics. Carry on.
Can you imagine? I'm going to tell you what's going to happen in the next 12 months, and you're not going to like it.
No one's going to.
I don't think that would work out.
Let's save everybody.
We'll have to see. Let's do this. Because of time, we need to speak to the most important person at the International Monetary Fund. This is the gentleman, when he speaks and speaks in this moment of post-pandemic, well, guess what? The room is silent. Tobias Adrian is Director of Monetary and Capital Markets at the IMF. What that means, he's in charge of the Green Book and all around financial stability here. He has enjoyed a recent American banking crisis. You people put out PhD fancy spider charts which show the different factors that are of challenge right now. Which spider chart and which factor in that chart matters right now?
Yeah, so I think what we have seen in recent months is that banking stocks have sold off quite a bit, in particular in the US and Europe, but the market more broadly has been fairly stable. So financial conditions have tightened to some extent, but it's really in the banking sector that we have seen most of the tightening, and that could have consequences down the line for macro activity.
I want to go to your work at MIT with Olivier Blanchard. He's all the rage. He's my book of the summer with wonderful difference equations on R-starred. Fold in the theory right now to the hardcore pragmatic realities of macroeconomics. Does theory matter right now? Does R-starred matter?
Absolutely. We published a chapter just earlier this week that is looking at R-star. And in our assessment, and that is very much aligned with what the market pricing is telling us as well, is that interest rates are going to come down in the medium term. Of course, at the moment they are elevated. Central banks have to fight inflation and then have to keep monetary policy tight. But over time, we do expect interest rates to come back down to R-star, which we estimate to be similar to pre-COVID.
Do you think we've seen evidence that this banking system can't handle interest rates at close to 5% at the Federal Reserve?
There's certainly stress in the banks and in the non-banking system, right? We have seen turbulence in both banks and non-bank financial institutions. And there's always a distribution of how much exposure there is to interest rate risk, to duration risk. And some of the weaker players have been under tremendous stress. And there are certainly possibilities that further stress could be triggered at some point.
Clearly there were some badly managed institutions, and we won't talk about them individually, but one Fed official said earlier this week that he does not think that it was because the Federal Reserve went from 0 to 5 in 12 months. Is that an assessment that you share?
So I don't think it's the speed per se that is at play here, but I do think that the rise in interest rates has been putting pressure on institutions. There are these unrealized losses, which are in the public domain and which have made headlines around the events over the past month.
Well, do you think, just to sort of put a bow on this, do you think that the stress shows that it is not worth it to necessarily raise rates further from here and cause that sort of more systemic stress in order to more rapidly get inflation back down to where it was pre-pandemic?
So the first order goal for central banks at the moment is to bring inflation back to target. I think there's no question about that. And both the US policymakers and the Swiss policymakers have been very successful in deploying other tools to ensure financial stability. There were aggressive actions in terms of lending and deposit insurance to contain any fallout. And that allows monetary policy to continue to tighten to fight inflation. Inflation is a big problem, and inflation has to come back to target.
We've talked a lot about trying to separate these two things, financial stability from monetary policy, fighting inflation. They're getting a little fuzzier, especially from the minutes where clearly you have Fed officials pulling back from some of the rate hikes. Do you think that a credit crunch is disinflationary?
There's certainly going to be an impact from the higher cost of capital of banks on their bank lending behavior. We have numbers in the GFSR. We estimate that to be about 0.45% in the US and a similar magnitude in Europe. So there is going to be an impact in our assessment from bank lending on real output. And that, of course, is going to feed back into monetary policy decisions, absolutely.
Okay, so basically, do you think that right now developed markets should not raise rates further and that they should just tolerate inflation being higher for perhaps a bit longer with faith that it will get back, in the IMF's view, to where it was pre-pandemic?
So we don't have the definite answer yet. It depends on releases around inflation, there could be upside surprises to inflation that may need further tightening of monetary policy. So, policy going forward is very much dependent on data, in particular on how core inflation evolves.
Well, let's talk about the data that might influence how core inflation evolves. Have you seen evidence that credit is contracting, that bank lending is contracting in America?
Oh, absolutely. We have seen a couple of data releases that have shown a certain amount of tightening in credit underwriting standards, as well as in the overall level of credit.
Can I be blunt then? What on earth was the Treasury Secretary talking about earlier this week?
I would distinguish a baseline and an adverse scenario. And I think the Treasury Secretary was talking about the baseline. When you look at markets, the market implied inflation is coming back to target fairly quickly.
You're being kind, because I think she said she saw no evidence of lending contracting, and you've said we do.
Yeah, absolutely. There is certainly evidence in the data of some contraction in lending and some tightening of lending standards.
Lisa, what a situation, some real daylight, again, between the IMF, and we're all looking at the same data, and the politicians, and the Treasury Secretary in the IMF is one example. Chancellor Hunt is another example of the same thing, although that's about projections and not realized information, but still.
We dismiss that as politics, but I would love your answer with that, Tobias. What the policy implications are of the politics of not reflecting the pain that is likely to occur when you get the policy prescription that you think is necessary to bring down inflation.
So absolutely, I think monetary policy is being tightened, and that is partially transmitted through bank lending. That's the classic bank lending channel. And, to get inflation down, of course, economic activity has to come down to some degree.
We're out of time, but I've got one real important question. I'm going to bounce it off Robin Wigglesworth's wonderful tour de force on debt in China and restructuring today in EFT. Just simply, if China is reticent to join the West in restructuring debt, does that change your financial stability?
So many countries are in debt restructuring negotiations, and there are many players that are important. You're mentioning one of them. And for those countries, it is extremely first order to get the debt restructured. For the moment, the countries that are impacted are smaller countries. So relative to global capital markets, I think that will not lead to broader contagion.
Tobias, this was wonderful. Thanks for waking up early. I mean, this is like
in Washington.
This is like lunchtime.
This is 2 hours early.
This is like 2 a.m. for someone living in DC, isn't it?
They open the doors here at 8:30.
Is that right? Usually.
That's early arrivals.
Tobias, thank you.
Tobias comes in like a polite 10 a.m.
Thank you very much.
2-hour lunch.
Very
Do you know that on 19th Street above it, you were mentioning earlier, the kindness here, there's a big, beautiful marble sculpture that says, "Be kind."
Are we being kind?
No, the IMF. They have a big, big marble
you just said no.
Do we have to be kind?
No, we don't have to be kind, but the IMF, you're always
okay.
Be kind.
Coming up, you mentioned China and debt restructuring. David Malpass of the World Bank. Looking forward to that conversation. It's a big topic for him and has been for a while. Gita Gopinath of the IMF coming up as well. And Raghurajan, formerly of the Indian Central Bank, now of the University of Chicago Booth School. Looking forward to that conversation too. Equity futures positive by almost 0.1% on the S&P 500. Live from the nation's capital through the next couple of days from the IMF Global headquarters. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Why 1953 specifically?
1953 has a lot of relevance in general. So that's the year where the European countries start opening up their imports to the dollar zone. It's the London debt deal with the Germans after the war around German debt. But it's also one of the years where the Fed is really forced to make a really important decision. So it's where a lot of their desire to get out of the bond market, and I'm sure we'll talk about what they did during the Second World War. It's a very controlled market. It's very heavily managed by the Fed on an active basis. They really pegged yields in the long end, and getting out of that is complicated. And in 53 is when the market really tests them. So we didn't have the "don't fight the Fed" mantra quite yet at that point.
But this is like a really interesting philosophical question right here, because there's always this question today or in any period, to what degree is the rate that we see on a 10-year, on a 30-year, on a 2-year, a policy rate versus a market rate? Before we get to 53 specifically, can you just talk a little bit more about what you said about how rates across the curve were essentially policy rates?
Yeah, when we think about a 10-year rate, like you could do one of two things. You can roll treasury bills every 3 months for 10 years, or you can buy a 10-year bond. So in a perfect world, those two things are connected through expectations.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
I wouldn't read a huge amount into this report in terms of giving the all clear.
When you look at the data right now, what we have to realize is that they are backward looking.
Even away from the banking stresses, we think now would be a very good time to pause and reassess.
I think they're going to go ahead and hike at the May meeting as well, and then take their pause. And I think you have recession coming later this year.
We're still a long way from 2% at this point.
This is Bloomberg Surveillance, live from the IMF spring meetings in Washington, D.C., with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from the nation's capital for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio from IMF Global HQ here in Washington, D.C., alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro, with equity futures on the S&P 500 positive by around about 0.1%. TK, we need to talk about a little division here in Washington between the IMF and certain select politicians. Earlier on this week, Secretary Yellen was in Washington doing a news conference and suggested she'd seen no evidence of bank lending contracting in the United States of America. We caught up with the IMF, an official from the International Monetary Fund, literally in the last 10 minutes, who said completely the opposite. Let's transition to the UK and talk about projections. A pretty gloomy outlook from the IMF for the global economy, including the United Kingdom. Chancellor Hunt is entitled to his view, spoke to Maria Tadeo of Bloomberg and come out and said, Tom, I disagree with the view from the IMF.
I mean, there's different narratives here involved. Let's say there's 6, 7, 8 narratives. We don't have time for that right now, but the polarity of narratives is simple. Some enthusiasm about a consumer, a continued growth globally, and completely on the other side is an IMF, and I think of Michael Darda at Roth MKM, who are suggesting diminished inflation and diminished real GDP on an American and global basis. These are huge contrasts.
Is this just the daylight, the contrast, Lisa, between politics and economics? Or is it something a little bit more than that?
Well, this is a great question, because are we talking shades of restriction, or are we talking an inability to really telegraph what is required to get inflation under control? And if that's the case, as I was asking Adrian Tobias there, how much does this reflect an unwillingness on the part of policymakers to do what's necessary to bring inflation under control? And here is where the patience and transitory question lies in. You know, can we tolerate 4% inflation for 3 years if we believe that we're going to get down to 2%? And oh yeah, by the way, we also save jobs.
This is the political overlay of macroeconomics, and indeed I would suggest microeconomics. And the massive overlay here in every article, every discussion, is the fragmentation the managing director speaks about, which is United States and China. And that's the we were talking here today, Tobias Adrian, and he made very clear he's not going to say the word China.
What do you think that is?
They're hypersensitive to not drawing themselves into this debate, even though the managing director is constructive about a recent visit to China. These are, go to Zambia. We don't need, this is way too early on morning American TV for this, but go to the Z letter, go to Zambia, and that workout with Zambia, that workout with the West, the Paris Club, the London Club. I love what Robin said about this morning. It's almost like there needs to be a Beijing Club because China's so involved.
Well, Tom, the IMF hasn't been shy about criticising other countries, been very bold about criticising the United Kingdom repeatedly over the last decade, and did so under Prime Minister Truss. So what are they afraid of? Are you suggesting they're afraid of not saying something about what is the defining moment in the global economy? I think the defining relationship, Lisa, which is the United States and China.
There's a clear academic construct right now that China is being overt in their criticism, and how do we respond to that is a huge part of the debate.
Well, and I also would argue this becomes very fraught because IMF includes China as one of the members. The World Bank includes China as one of the members. And yes, China is a big lender globally, both on its own as well as with the IMF, and is a big contributor to some of the budget. So it becomes a real fraught discussion real quick.
David Malpass of the World Bank is coming up a little bit later. He's been very outspoken on this issue, and I look forward to catching up with him again on that matter. We'll catch up with Gita Gopinath as well. Lisa's going to run you through the day ahead, some of the economic data, some of the great interviews we've got lined up for you as well through this morning. Before we get to that, let's start with the price action. The S&P 500, just about positive on the S&P by 1/10%, a lift here in the equity market. Yields on a 10-year higher by 3 basis points, 342.43. Let's just call it 342. In the FX market, reclaiming 110 on euro dollar. I think you have to go back to early February when we saw 110.33. That was the day of the ECB and the day before that monster payrolls report, which engineered a snapback in the US dollar. But over the last several weeks, Lisa, you've seen it, the euro on a comeback, the dollar on a come down.
And the debate will be, is this dollar weakness or is this euro strength? And people continue to debate that. And I wonder how much LVMH kind of feeds into that in the China story. We'll talk about that coming up. 8:30 a.m., we get the economic data that matters this morning, U.S. jobless claims, as well as March producer price data. The jobless claims information, to me, is getting more and more interesting as we start to see just a slight uptick in people filing for benefits after losing their jobs. Today, we also, of course, are following the IMF and World Bank meetings. Bank of Canada Governor Tiff Macklem will be speaking, ECB Governing Council member Joaquim Nagel as well. And on Bloomberg Television, we've been talking about our discussion with David Malpass, which I'm very excited to say will be coming up, and also Gita Gopinath of the IMF, especially after they made this call on inflation and rates going back to pre-pandemic. How long will it take? Maybe the key question. 1 p.m., the U.S. is selling $18 billion of 30-year bonds, and here is where the question really comes to bear. Right, John? At what point are people going to price in that inflation is going to remain hot for a very long time because no policymaker will ever have the conviction to really cause the pain required to bring inflation lower in a structurally different kind of economy?
Maybe the banking shock will do it for them. This from Torsten Slock of Apollo just moments ago. Credit conditions have tightened significantly for small businesses following the SVB failure. Firms, Tom, with less than 500 employees account for almost 50% of total employment in the U.S. economy. That's the latest from Torsten this morning.
And what's interesting is when the data dependency begins to weaken, it's when things are moving quickly. And I think everyone at these Washington meetings would access we're seeing an accelerant now of present data, which changes that confidence in ex post data dependency.
So let's get to Darryl Cronk from Wells Fargo, the Chief Investment Officer for Wealth and Investment Management. Darryl, can I just start with the bank earnings, which are due to start pouring out tomorrow morning? What are you looking for from the C-suite, from corporate guidance?
Well, good morning, everyone, and it's a fascinating discussion this morning. I do think you're going to see some pressure and some, let's call it conservativeness out of the bank earnings tomorrow. What's interesting is if you look at the loan data from just simply last week, because we get high-frequency loan data, last week was the weakest loan data or most contraction for any single week since 2010. So going back to the prior conversation about, are things weakening? Are they slowing down? Absolutely. Understand financial conditions and lending tighten before loans do. Loans are a lagging indicator, not a leading indicator. So you'll see loans come. And I think to your point on the banks and earnings, John, I mean, what's really important here is if you think about the normal sequence, it's a liquidity event into a profitability event, which could then lead into a credit event. In that sequence, right? That's how history has always taught us it plays out.
I can't say enough, Daryl, about that analysis and particularly the profitability part. And that folds into your research note on small caps. Does Wells Fargo abandon small caps here because of the present fragility?
Well, you have to certainly look at them in an unfavorable way, and that's where we've been positioned for some time. What's interesting, Tom, is small caps have had a full round trip already this year. So from January 1 to early February, small caps went up 15%, and then they gave it all back from early February to late March, basically. Certainly the earnings are going to be challenged there as small businesses have to pull in the reins and just can't get access to credit at the levels that they need or are used to, and the credit that they can get, they're going to pay higher for. So if you look at small caps, even from a technical standpoint, they're actually stuck below the 200-day moving average. The reality is, if this rally we've seen over the last couple weeks is durable and sustainable, small caps should be participating, if not outright leading, and the reality is they're just not.
Well, Daryl, so basically you're saying that you don't see this equity rally as sustainable. Is that correct?
Yeah, we would fade it up here around 4,100. I think the last time I was on the show, we were about 4,150, 4,160. Continue to be cautious here. You're just not getting paid to take risk on an equity risk premium at this level. The reality is that day will come. It's just not here yet, in our opinion. And earnings still have to come down, in our opinion.
Okay, so at what point will the earnings that we're seeing from Delta, from LVMH, give you confidence that people still are spending money, still have it to spend, and some of these companies are able to capitalize even bigger margins than they used to?
Yeah, that is the interesting point, Lisa, because I think what you'll see in this total quarterly earnings, obviously we know earnings are going to contract. The bottoms-up consensus is about 6%. They'll come in better than that, but it'll still be the second negative quarter in a row. Where all the pressure is at is on the margin line, and what that's telling you is companies aren't able to raise prices at the level they were able to in 2022 and 2021 to sustain that. So as cost pressures remain high, think higher inflation, and yet you can't increase prices, all of that goes straight to the margin line, and we think is going to just accelerate some of that pressure on earnings as we go later into this year.
Hey, Daryl, this was great. Going into earnings season with the banks on deck tomorrow morning. Daryl Cronk there of the Wells Fargo Investment Institute. For all this gloom, if you listened to this program over the last 70 minutes, would you have guessed that unemployment in America, Lisa, was at 3.5%?
No, that's exactly the issue, is that basically for all the gloom, there's a lot of positivity that the bulls will look around and say, why are you guys ignoring that?
Okay, you mentioned Neil Dutta earlier. I'm going to go to core Dutta right now, and that is inflation comes in and doesn't impinge on a little bit of wage growth, maybe not a lot, but real incomes flatline or improve given disinflation, and that goes into consumption as well.
That's the bullish view. That's what the bulls would love. I mean, that is the bullish view.
Or does it just take you away from the convenient gloom everybody's feeling?
Convenient gloom. It's not convenient. Yeah. It's painful. Honestly, I will say, Lo, before we get into some sort of therapy session, there is this issue of what we get when it comes to.
There's no danger of that. Go on.
Of course not. Let's just talk about it with Godot. But I do wonder if, looking forward, that view is going to allow the disinflation that we need. Though, again, this goes back to: should we tolerate a higher inflation rate in the United States?
Do you know they're setting up a band behind us?
I noticed that.
Did you notice that?
Yeah.
It's the Canadians have come. You know who's playing here this morning for Dr. Gorgieva? Nickelback's here.
Oh, very cool.
Yeah.
Haven't heard from them for a long time.
Are you making that up?
I don't know. Nickelback's there.
You've started to believe these stories.
I'm just wondering.
There's a rule of Bloomberg surveillance. Allow me to share it with you. Never believe these stories. Mike Wilson, the CIO and Chief US Equity Strategist at Morgan Stanley, joining us in about an hour from now. Much more from IMF World Headquarters here in Washington, D.C. Gita Gopinath of the IMF, David Malpass of the World Bank. Malpass up next.
You got me. I believed it for a second. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, the White House is rejecting an outlook for the economy by Federal Reserve staff. Fed minutes published on Wednesday said the staff sees a mild recession starting later this year. But a White House spokeswoman says the data doesn't indicate that, pointing out recent numbers on jobs and consumer spending. The British economy took a bigger hit than expected from all those public sector strikes. It stalled in February, but a stronger January reading of the GDP reduces the risk of recession this year. Still, the UK is on track for an extended period of stagnation. In China, exports unexpectedly rose in March. They jumped 14.8% in U.S. dollar terms from a year earlier. Demand from Europe and most Asian countries improved. That boosts the economy's outlook and indicates global growth may be better than expected. A federal appeals court will allow limited access to the abortion pill. A 3-judge panel partly granted the Biden administration's request to put on hold a Texas court ruling that overturned FDA approval of the medication. On the other hand, it allowed restrictions on abortion that were lifted since 2016 to be reinstated. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Looking ahead, there are good reasons to think that policy may have to tighten more to bring inflation down. But there are also good reasons to think that the economy may continue to slow, even without additional policy adjustments.
That was Mary Daly, the San Francisco Fed president. Plenty of Fed speak through the week. I have to say some cracks in the enthusiasm over hiking too much later on this year. Implied in their projections is one more hike, and some people maybe even suggesting they wouldn't go that far if we get more incoming information on the banking stress which has developed over the last month. Allow me to share with you the price action of the morning so far. Equity futures positive by a little more than 1/10% on the S&P 500. Yields bleeding just a little bit higher in the bond market. Up a couple of basis points, up 3 basis points to 342. But there it is. We reclaim 110 on euro dollar, Tom. 110.13.
I'll be like the pros look at euro yen, triangulate dollar and euro over to yen. I don't see a breakout there, a technical change, if you would, but there we are.
Close to highs of the year, very close.
To save every second here and every minute right now at these meetings of the World Bank and International Monetary Fund, an annual visit with David Malpass, outgoing president of the World Bank. And instead of talking World Bank affairs, aid to the world and the struggles of the war in Ukraine, we will hearken back to Mr. Malpass's moment of 07 and 08. More than anyone in this building and set of buildings, he lived front and center at Bear Stearns' previous financial collapse. David, thank you so much for being with us. I'm not going to ask you an easy question like, does it allude back to 08 right now? But the stresses that you see right now in American banking, in the huge tensions between China and the United States, does it lead to that word suddenly, where suddenly things can change as they did in 08?
Hi, Tom. Hi, everyone. There was a maturity mismatch going on then too, and it maybe from the same causes. Remember, in the 2000s, interest rates were being raised very slowly, and so that built up a giant maturity mismatch, which some companies were funding with repos funding treasuries, so in treasury bonds, and so in that way it harkens to now. We have in the U.S. banking system, some banks are funding treasury bonds with deposits. But a big difference now is the biggest duration mismatch is the Federal Reserve itself. It funds uses overnight borrowing to fund a giant bond portfolio, some $9 trillion. The European Central Bank, $8 trillion. And I think the dominant feature now is the asset allocation that came out of that. If you have giant buyers of long maturity of duration. In effect, the central banks were buying giant duration. And so what that meant is it distorted all world markets, and we're now in the workout phase. There'll have to be a normalization of interest rates. It means pressure on asset prices for a long period of time. That's what's showing up in the meetings here. The expectation that there'll be weak growth for a while puts pressure on people in developing countries throughout the world, and that pressure is getting intense.
Frame the distinction between the World Bank weak growth call and that of your colleagues at the International Monetary Fund. Both of you, to editorialize, have been grim. What's the Malpassian level of grim in your forecast?
Ours are a little weaker than the IMF's, but remember, they often do one in purchasing power parity. So if you adjust for that, there's not that much difference. We use market-based exchange rates, and so ours is 2, and theirs, I think, would work out to 2.4. So they're both weak forecasts for 2023, and that's showing up in the U.S. You saw the Federal Reserve saying maybe in the U.S. a recession, mild recession in the second half.
And what's great about this is Malpass uses a slide rule from Colorado College Physics.
Oh, very cool. So this is growth. Let's talk about debt, if we can. This is something you've been really outspoken about, David, over the last few years. China, the world's biggest creditor to poor nations. I understand there's been some conversations this week. What's their position now, if we could start there? And then if you could tell me whether you're satisfied with it.
The debt has grown up over the years. The composition of the debt is different from in the old days. That used to be U.S. banks that were lending to foreign countries. Now we have China and the Eurobond market lending to developing countries, sovereign debt. So there was extensive talk yesterday. I co-chaired with Kristalina the debt roundtable. China came at the level of the PBOC governor and also the Ministry of Finance of China, and so they participate in the discussion. And there were some agreements. There was agreements that there needed to be more timeliness of the launching into a restructuring process. That there needed to be data sharing. China has asked from the beginning, can't we get the data earlier? That hasn't been the tradition, but that's going to be, and there's a paper to do that. Also a working group, which is important, on the technicalities of burden burden sharing? How do you have equal burden sharing among creditors so that they all participate in the restructuring process of the debt? This is really important to the people in developing countries because their governments are paying these large, high, not low interest rate, kind of market rate or above market rate debt. And it means it's draining the countries of what they need for nutrition, for health, for education, for climate adaptation.
Are you satisfied with what China's committed to, or do you need to see more?
We need to see this week, and it was mentioned last night. Yesterday there were big meetings, so we had the G20 meeting, the G7 meeting of finance ministers, the development committee, the governors of the World Bank met and expressed strong support for the World Bank leadership. There was discussion at the G20, even late last night, of the specific countries that needed to get action on debt relief. Zambia was here. I had a panel earlier this week with the Zambian finance minister, the Ethiopian finance minister. They're burdened by high levels of debt. So the proof is in the pudding. The details of, is Zambia going to get an MOU? We'd like to see one this week. China needs to be willing to sign off on the structure of the restructuring.
One big question has been transparency and a lack of it, and a lack of understanding of just how much debt China has extended to a lot of developing nations. Do you walk away from the meetings yesterday with a greater sense of how much debt they currently have tied to the developing world?
We know quite a bit about it, but not the full extent. And there were calls yesterday, and there's specific discussion of this, that some people say swap lines by China's central bank should be left out of the restructuring. Some say it should be included in the restructuring. There was talk about the what to do with arrears. So as these restructurings drag on, the interest on the interest goes up and up. So can you agree in advance on how to handle that? And so it gets straight into the details. There was a proposal made the proposals across the board on how to handle this. So I think there's lots more work to be done, but at least there's a technical or a workshop that's going to be set up to bring people up to speed on how you calculate net present value reduction within a debt restructuring.
Would you identify this and everything we've just discussed over the last few minutes as the #1 issue that you're handing over to your successor at the World Bank?
Well, certainly debt transparency is a giant issue. There was a call yesterday for the debtor countries to release the contracts that have non-disclosure clauses. So that's a specific thing that will outlast me, and it's not going to get resolved this week, but I hope it does. You know, China has written into the contracts non-disclosure clauses. That was specifically discussed. So as we look toward the future, I think what I'm handing over to my successor is a World Bank that's in really good shape. That was a main theme from yesterday's meetings, but also in a developing world that's under this giant pressure from too much debt, but also not enough growth coming out of the advanced economies.
Well, this won't be the end of our conversations, you know that. It's great to catch up, David, as always. David Malpass there.
Nice to see you.
The President, Tom, of the World Bank.
I think that these are challenging issues. You talk about the World Bank and aid, and we spent the entire time on debt restructuring. This is the milieu we're in.
I talked about education, about health, but
David,
these
we have to go to
poverty.
David knows that. He's just not done. You can stick around for Gita Gopinath if you like. She's coming up from the IMF a little bit later this hour. From Washington, D.C. this morning, good morning. Kelsey Barrow of J.P. Morgan coming up next.
Okay, so you're moving in on me. Quick. You're distracting me with your fancy hands. I'm going to deal with your knight because this is really bothering me.
Ah, my knight.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right. I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from Washington, D.C. this morning. Good morning to you all from the IMF Global Headquarters here in the nation's capital. Counting it down to the opening bell a couple of hours from now, the market action looking a little something like this on the S&P 500. Equity futures slightly positive by 0.1% on the NASDAQ 100 up by 1/3% this morning. Just a little bit of a lift in the equity market, no real drama here. The next stop, jobless claims, which are due in about an hour from now. Then on to tomorrow, retail sales and a ton of banking earnings. So we're going to do a lot on the banks for you tomorrow. Going into all of that, 2s, 10s, 30s look like this on a 2-year at the moment. Yields in America, higher by a single basis point, 397 on a 10-year, higher by 2 or 3 basis points to 342. Again, no drama there. For once, at the front end of the curve, pretty muted price action with the exception of the move off the back of the CPI report just yesterday. Want to finish on foreign exchange. Here we go. Euro dollar back at 110.
It's saying something.
Yeah, euro dollar 110.16, positive 0.2%. That, Tom, a slightly stronger euro in the mix this morning, slightly weaker dollar.
There's equities, bonds, currencies, commodities, and cardinal rule number 1 is the weighting changes and the dynamics change. And foreign exchange has been pretty quiet. And maybe this is the wake up, getting out through the summer of finally a giveaway in the dollar. With all the dynamics going on, is that one outcome? And it bears really close watching.
So it was interesting yesterday watching the price action off the back of CPI.
Yeah.
You saw yields drop quite aggressively and then come back, Lisa. You saw the dollar weaken quite aggressively and then not come back.
Stay there.
And that's been the story this morning with euro dollar too.
Well, and again, that's why I go back to, is this dollar weakness or is this euro strength? Because are we getting some sort of strong, resounding sense that Europe is in a better position? Or is this really a feeling that the U.S. is done with rate hikes or perhaps one more and then we'll be cutting into the end of the year?
I strongly support the study of an asymmetry like that, but then when you triangulate it with another pair, it becomes even more powerful. So the pro case is euro dollar, dollar yen, and then take out the dollar, what euro yen dynamics do, and that'll be something to watch.
Yeah. Listening to the Bank of France governor this morning, I didn't hear the enthusiasm to keep on hiking after the next meeting at all. I still don't believe, and for what it's worth, this market still does not believe in this idea that there is a second sequence to this. And the first part of the effort is to get rates up really quickly. And this is what Kashgari talked about in that blog to start the year. There is a second piece of this, and it's the waiting. And the waiting, and the waiting. And the market doesn't see it that way. If you speak to people in financial markets, they see the pause and cutting as part of the same story. And the Federal Reserve and the ECB do not see that story at all in any way, shape or form. They see a pause and a hold for a long, long time.
Yeah, I mean, look, this is the unknown, and a lot of people yesterday came on, including Jeff Rosenberg of BlackRock, and said, you know what, we aren't buying what the market is selling. We think that they're perhaps a little ahead of themselves with the rate cuts. That said, you've pointed this out before, John, that where if you hold, it becomes a whole lot more restrictive as the economy continues to slow. We talk about slowing economy, but I have to say, you're not seeing it when it comes to consumer spending. We talked about LVMH. Those shares a little changed ahead of the market open after rising to a record, but I wanted just to give give you a sense before going into the airlines of just how much the Chinese consumer is really driving action. With this is to me amazing. Organic sales of the group's biggest unit rose 18%, which was twice the gain the analysts were expecting. So how much is this? People really coming in and having a lot of money to fly around and to buy luxury goods. Delta also out this morning. They actually missed on the first quarter, but they expect the second quarter to be much above expectations. Those shares up nearly 3%. And this is what I find interesting. The revenue per passenger is going up and exceeded expectations. Again, I go this.
I'm not surprised.
I mean, I'm not either, right? So this is basically margins increasing despite all of the discussion about contracting margins, because guess what? They can.
I look at the ratio of business class to economy. It used to be 2 to 1, 3 to 1. Sometimes now it's 7 to 1. And critically, that ratio is within economy going up to stupid levels.
Yeah.
The new $300 flight
so expensive.
is $650, $700.
It's so expensive.
You know,
and a lot of these airlines are packing out the business cabin now as well.
Yes.
They're expanding them.
Yes.
And dropping the first class cabin in some of these planes as well, at least that's the direction of travel.
I've noticed it.
I'm sure you have.
I've noticed it.
Because you used to sit
very
there.
much.
Yeah.
Anyway, the other airlines are also popping in sympathy, although American Airlines less than United, which I think is interesting. United and Delta kind of shifting away from American a little bit. Which we
Interesting. Subscribe. It's that time in the morning where I say subscribe because Lisa's paying for breakfast a little bit later. Sign up at Bloomberg.com.
The enthusiasm is just shocking
for the
right
Bramo newsletter. I've been promoting this all the time. I love your work, Bramo. You know that. The surveillance newsletter, bloomberg.com/surveillance. We are going to change the name of that, Tom, in the next couple of days. Give it a few days.
Surveillance Toxic Brew.
Oh, without a doubt.
How do you do it every day?
The daily Toxic Brew.
We got to get to Kelsey here. How do you grind this out every day in your 6-hour work day?
There is a team, first of all, of people who are incredibly helpful.
There's a team of ghostwriters. Whoa. Have you got ghostwriters? Is that what you're suggesting?
I will say this. There is, usually when we come in, and I know that you guys do the same thing, there is a theme that you believe in, that you kind of test out every day.
Where's the coffee? That's the theme.
You sort of see where it goes, and then you figure it out.
Okay.
We have, stuff that comes
But it's
out.
you writing it, right? Okay.
She doesn't even look.
Oh, come on. That is just not true. Misinformation.
I'm working with Lisa Abramowitz. Oh, my word.
You've got a team of writers.
We will continue. Kelsey Barrow's waiting very patiently. You want to read in on this, on what the big change, what they're doing here?
Oh, yeah, look, this is the view from Kelsey Barrow this morning. I'll bring the quote just briefly.
Sure.
Whether or not the Fed follows through with a rate hike in May is mostly irrelevant to us. The US economy is increasingly showing signs of weakening growth and disinflation and is more vulnerable to shocks after more than a year of aggressive policy tightening. To that end, and here's the call, Tom, we continue to have a bias to lower Treasury yields and a steeper Treasury curve.
Global Wall Street lean forward now because when the facts change, Kelsey Barrow changes. She works at Fixed Income, JP Morgan Asset Management. What an abrupt move, Kelsey. Here, let's get a benchmark on a 10-year yield. How low can it go? Can it go 3 or can it go 2.XX?
Right. So our bias is for Treasury yields to move lower. We're expecting through 2-year and the 10-year Treasury yield to move towards 3%. So that implies that the yield curve is going to uninvert and it's actually going to start steepening. So the things that we're watching right now that are leading us to that conclusion and increasing our confidence around this, you've been mentioning, do we have to wait till the senior loan officer survey? That's all the way in May. Well, we're seeing data that's already showing that credit conditions are tightening. So I'll just give you a few examples. NFIB, that came out on Monday. It has a subcomponent about availability of loans. That's the lowest level since 2012. Another one, the American Bankers Association also have a credit conditions index. It's the lowest since COVID and even lower than the GFC. So we're seeing it really across the board. The credit condition tightening is occurring.
If I'm going to speculate in the land of Michael and Barrow, what duration do I want to buy to go price up, yield down? What's the most effective duration?
So, well, when we're thinking about the view that the yield curve is going to steepen as well as yields are going to fall, that would imply you want to, have some of your duration in the front end of the curve because that's going to give you your biggest bang for your buck. But on the other hand, we do think that there is merit in in locking in longer term yields here as well. This has been a historic repricing in bonds, and you haven't yet missed the moment to lock those rates in, even though we have seen a rally so far this year. And so that's really what we're looking at. We feel right now that we're in this in-between time, this waiting period. It's this period before when the Fed stops hiking rates and before the Fed starts cutting. And in that period of time, you have the soft landing camp, the hard landing camp, and the recession camp all claiming that they're right. And in reality, what happens is on the path to a recession, we go through a period that looks like a soft landing. So there's been a bit of an improvement in liquidity and in sentiment more recently. We wouldn't get complacent about that. We think it's probably temporary. And the next thing we're focused on is bank earnings as well as the debt ceiling.
So, Kelsey, it's a transitory soft landing, and we perhaps will see a transitory type of inflation that will move to something that's lower. How long do we have to wait with inflation well above the Fed's target before it's no longer transitory and we're actually just looking at, say, 3.5% inflation that is basically the new normal for years on out?
So we do have to acknowledge that year-over-year inflation is still high, and that's, of course, a reflection of what's happened over the last 12 months. But, you know, when we look into the CPI report, we see a number of indicators that suggest that inflation should be coming down, that there is more disinflation in the pipeline. So on the good side, supplier deliveries within the ISM are at the lowest level since 2009. Now, if you're at home, map that index, supplier deliveries, to core CPI, and you're going to see there's a very tight fit, and it suggests there's a lot more disinflation in the pipeline. Now, when I show that to people, the pushback is, well, what about wages? Well, on the wage side, average hourly earnings, the 3-month run rate, it's declined to the lowest level, 3.2%. That's a level that actually the Fed would consider sustainable when they look at it. They think 2% inflation, 1.5% productivity. That gets you to a 3.5% sustainable wage growth. We're actually trending in that direction fairly fast. So, you know, the Fed is going to have to be patient on this one, and they haven't had the luxury of time on their side. But we do think that there is a fair bit of disinflation in the pipeline. The recession is ultimately what's going to get inflation back down to their target. But we do see that there's quite a lot already there in the wings.
Hey, Kelsey, this was great. Kelsey Barrow there of JP Morgan Asset Management with some artwork from Bob Michael behind it. Did you notice that?
Yeah, but you know, we talk to these people all the time. It's really hard to keep score, but I love that there's abrupt
Did you not notice that?
I noticed the artwork. Was that his?
Yes, Bob Michael's, yeah.
Oh, okay.
Yeah, he takes it into JP Morgan.
I love the...
I'm so confused.
I love how they've changed. I mean, it's very cool. These are some real seismic shifts from these major banks on the view of the outcome.
Can we just share, we've had a Chairman Powell sighting.
We had two things going on here. Surveillance correction here. I thought Nickelback was playing. I have been corrected.
You confused Nickelback and Chairman Powell.
With Jerome and the dot plots.
Okay.
They're going to be coming up here playing area. Actually, Chairman Powell walking by here near the 50-yard line. And I said, come on up and talk to us. And
I'm guessing he didn't fancy it.
I didn't have the charm that Yahira has.
What's the genre? Country?
Oh, no, it's blues. Come on, they're grim.
Can I just say,
it's blues. There's only one thing.
Jay and the Dot Plot actually sounds like a good band.
That sounds fantastic. I would listen to Jay and the Dot Plot.
Your buddy guy like nobody.
John Lipsky, the former first deputy managing director at the IMF, is going to be joining us shortly. Looking forward to that. From IMF Global HQ, this is Bloomberg.
Tom Keene, I can't even. Jerome and the dot plots. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Fed officials feel they need to do a little more to tame inflation and are leaning toward another interest rate hike next month. That's according to minutes from their March meeting. This despite forecasts from Fed staff advisors that there will be a mild recession later this year. Another missile launch from North Korea. A suspected intercontinental ballistic missile was fired toward waters off Japan's northern island of Hokkaido. Now, that prompted a brief warning for residents to take shelter. South Korea says it's possible that North Korea may have tested a new type of solid fuel missile. There's a report on the alleged leaker of those U.S. intelligence secrets. According to the Washington Post, it's a young gun enthusiast who worked on a military base and shared the classified documents with a group on Discord, an online platform used by gamers. He was known as OG and told the group he spent some time inside a secure facility. Discord says it's cooperating with authorities. Some fellow Democrats want Senator Dianne Feinstein to resign. The 89-year-old has been absent for about 2 months with a case of shingles. Representative Ro Khanna tweeted that it's obvious she can no longer fulfill her duties. Another Democratic congressman, Dean Phillips, said it was a dereliction of duty for Feinstein to stay on. And Feinstein says she's asked to be temporarily replaced on the Judiciary Committee. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside of that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
What we shouldn't be doing is saying we've got such a problem with financial stability that we have to, in a sense, aim off a decision on monetary policy which is taken with, obviously, with our inflation target, primary view, because of conditions in financial stability.
Andrew Bailey there, the Bank of England governor, here at the IMF global headquarters, Tom, over the last couple of days. I have to say, TK, that's the view of the Bank of England, and we should be very specific about that. That's the view of the Bank of England, a view shared by the ECB. It's a different kind of shock here in the United States of America.
Hugely different.
A completely different shock, which is why the Fed has already acknowledged to some extent, to some degree, the shock we've seen over the last month will be a substitute for rate hikes. We don't know how much of a substitute it will be.
Wrapping into their original politics is the fact their core inflation is not our core inflation, and the vector's nowhere like ours right now. We're doing better here in terms of getting rid of this difficult
Agreed.
inflation.
It's a different story.
Different story. Right now we're going to do this for these IMF and World Bank spring meetings, bring in someone qualified with historical perspective. The academics are Wesleyan and his Stanford, and of course his work now at Johns Hopkins. John Lipsky joins us, former first deputy managing director at the IMF. with all sorts of heritage, I would say. I got to ask the first question, given the times, will you return to the IMF, the World Bank, or other august institutions?
Well, I always enjoy visiting, but I think they've got plenty of very capable folks here.
What are the state of these institutions now in handling this crisis, somewhat different, so different from what you lived in 07, 08?
Oh, yes, absolutely. For one, we didn't have to operate in the sense of a spirit of great power competition. Instead, there was a sense of cooperation. The G20 was formed instantly. The G20 leaders process was created in the wake of the global financial crisis. And if you remember the April 2009 G20 summit, the second summit, added $1 trillion of resources to the IMF. So there was real agreement on dramatic cooperative action. That still has to be forged in both here at the IMF, at the World Bank, and more broadly.
Well, let's cut to the chase.
G20 itself.
One of your most historic speeches on the Pacific Rim and a burgeoning Vietnam in Hanoi is you spoke, of course, to the large China adjacent to Vietnam, how things have changed from when you were on the watch. What is your interpretation of what Washington has to do, what Beijing has to do to get everybody on a more constructive page?
Well, one of the implications of the changing situation, you heard just a few minutes ago from David Malpass, the outgoing president of the World Bank, that we have seen coming this crisis, debt crisis, especially of emerging and developing countries, especially affecting the poorest. There needs to be a new cooperation forged to deal with that successfully, because the pre-existing Paris Club arrangement simply doesn't work. What you heard about was this debt roundtable that met for the first time yesterday is an attempt to create a new forum for cooperation, not just China, but also the private sector has felt left out of the negotiations around the process, and they're being brought in for the first time. So there's a lot to do, but there's hope that this new format will produce some progress.
Although how much is the larger sort of Belt and Road Initiative or using lending to the developing world as basically a foreign policy effort and trying to shore up support, how much is that shaking the foundation of the IMF in this sort of joint collegial effort to try to support certain nations for the goodness of the world?
Well, the balance has changed a lot, but of course, there's been a lot of bilateral lending that often in the past that always has some kind of a policy focus to it. It's not just for the goodness of the world that these loans are made. So what's happened here, of course, is that the size of China's involvement has become very large. But again, I emphasize, if there's going to be a solution, and now the crisis is coming upon us, a solution is needed. Something has to happen. Everyone's going to have to give and compromise, and the private sector has to be involved in a more direct way than has been the past.
I want to shift gears a little bit. The IMF came out and said that they see rates going back to where they were pre-pandemic, and eventually we will get inflation back to where it used to be. A lot of people push back, including BlackRock, coming out and saying, Larry Fink saying potentially inflation at 4% for a very long time. Where do you stand on this as a former banker as well as one of the leaders of the IMF?
Dare I say it, one of the little secrets of economics is economists have only a weak grasp of the process of price formation. And as we've seen over the past decade is that central banks' ability to finally control inflation is much less direct than might have been thought or hoped. So did we see coming the big surge in inflation? Most people did not. Can we feel confident we know what is going to happen with inflation in the next year or 2 years? I think we need to watch carefully, and I hope that, well, count me an inflation optimist. I think it's going to prove less sticky than many do.
Well, some people talk about the monetary policy not having as much of an impact, the structural change. Larry Fink saying he sees the work from home dynamic as actually changing the inflation debate, that the work from home doesn't work and that productivity is dropping off, and that's the reason why inflation is going to stay at 4%. Do you agree?
I say we'll see. We'll see. All I can say is I find working from home pretty good.
Hey, you're not alone.
And among other things, especially dealing with international discussions, it's so easy to connect internationally in a way or at a distance than what could have been done before. I don't think that that's bad for productivity.
John, in that piece earlier this week, if I can jump in because we're up against the clock.
Yeah.
There was a line in there, and I think the IMF acknowledging how difficult it is to forecast this stuff. It said our projections are only good as the projections that underpin them.
Yes.
And 2 or 3 of the issues that stand out, and I'll pick out 2 of them. One is this transition to new sources of energy, and the other is deglobalization. And there are many people watching this program right now, listening to, who believe there is a secular component to this inflation story. Do you have any appreciation for that kind of thing, which is what I think Elisa is trying to dig into?
Well, look, the last 25 years in the United States, inflation has generally been, with only 2 years exception, at or below the Fed's target. The notion that this is inherently an inflationary economy is not obvious to me. And right now, we have people who have bet their personal finances on the maintenance of low inflation. So I think there's going to be a lot of support for policies that will keep inflation low, because if we don't, if we fail at that, if interest rates stay high, we have not just a fiscal problem, we have a personal finance problem.
I want to ask you, as former vice chairman at J.P. Morgan, if Diamond's on target to do 5 days of work week here and lose work from home, but forget about that. This is too important. Do we lose a 2% line? John Taylor of Stanford is adamant there's efficacy to keeping those rules-based structures lower and lower. Do we have to reset 2% to a higher level?
I don't think so. It's not obvious to me what would be gained at this moment by announcing that we're going to change our definition of where fever lies, and we're going to decide that actually you can have a higher than 98.6% fever temperature, and it's going to be just
See that
fine.
Stanford economics just powers through there? Those guys on the East Coast,
Hey, John, thanks for this. Just wonderful. John Lipsky there.
It's always great to
With a different view, Tom, on things. We're going to catch up with Mohammed Al-Arian tomorrow, who I know has a different view on this situation. Let's put it
well, within the publishing here, and of course everyone's publishing here, folks, as we go into these meetings. Richard Clarida, Dean of Columbia Economics, as a former vice chairman, even suggested not that there would be a policy, as Dr. Lipsky talks about, to move away from 2%, but maybe the end result we would be higher than a 2% set.
There is this idea, and some people, the cynical ones amongst us, believe that this is something...
Let's all look at Lisa.
I might be speaking for myself as well here, Lisa. There are some people out there who believe that the Fed may well want to go in this direction, but now is not the time. Now is not the time to make that shift.
There is a tension right now between being aggressive to bring inflation down in a tangible way sooner and having the patience to wait, knowing that if inflation ends up at 3%, it's not the end of the world. Okay, so we can live with that because a temperature at 99 isn't that really a temperature if you're, otherwise going to go
I got an email. Who's playing drums for Jerome and the dot plots?
Who is that?
Goolsby.
Very
He
cool.
looks like Mick Fleetwood.
Does Goolsby play the drums?
Yeah, he's phenomenal. He's at Milton Academy. He was like scary good years ago.
I don't believe you.
He's like a Mick Fleetwood thing. He's sitting low on the chair, hitting the cymbals up.
Clarida, he's the singer.
Rich is a singer.
Rich is going to be the singer and the guitarist. So then
Tom's a guitarist too.
Exactly. So you want to do backup?
No, I'm not going to sit in. No, but Goolsby plays drums like a Democrat. That's all there is to it.
What does that mean?
What does that mean? Lipsky got it.
Mike
He's like
Wilson
every offset
of
now.
Morgan Stanley joining us next.
Every art institution I know of wants you to serve on their board, and you're very involved in the art world. What is it about art that attracts you?
Well, art is essential in a democracy, David. Art is so important. We know what art does to young people. We know that exposure to art brings about higher levels of empathy. It helps people understand how other cultures, other people live. And it just brings out the kind of humanity in all of us. There are times when I have observed leaders use language that is inhumane while talking about other human beings, while talking about the world. And I think to myself, this person has clearly never engaged in beautiful poetry. They've never listened to the words of a great playwright. They've never sat and reflected on a beautiful painting or picture. Because if they had been really educated, had they really been exposed to the arts, they wouldn't find it possible to use this kind of language.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
The Fed worries about inflation. When nominal GDP growth is weak, they'll have a whole host of other problems to contend with.
I don't agree with the view that the Fed's going to be cutting rates by the end of the year.
You have a Federal Reserve that says we're not done hiking. We have more work to do.
I don't think we should feel comfortable that the worst is past us.
It is particularly a period of heightened uncertainty around the outlook.
This is Bloomberg Surveillance, live from the IMF spring meetings in Washington, D.C., with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from the nation's capital for our audience worldwide. Good morning to you all. This is Bloomberg Surveillance on TV and radio from IMF HQ. In a couple of minutes' time, we'll catch up with Gita Gopinath from the International Monetary Fund. The meetings continue down here in Washington, D.C. Going into this morning, equity futures were slightly positive, just turning over in the last couple of minutes. We are negative on the S&P 500. Tom, a ton of fantastic guests lined up. We need to talk about the data, though, which we get in about 29 minutes' time.
Data front and center here. I want to note that the futures rolled over because I knew Mike Wilson would be on here in moments. But the answer here is claims at 8:30 has a renewed importance. Lisa mentioned it earlier. There were adjustments. McKee understands this. I don't, folks, to be honest. But there were adjustments made last week, and we now need to see, do those adjustments continue their trend to more claims and potentially higher joblessness.
A breakout last week off the back of those adjustments. There's a difference between levels and change. The levels are still historically exceptionally low.
Oh, yeah, absolutely.
Exceptionally low. But that change will get your attention if we get that snapping back again.
Yeah, really well said. And the point here is that the pros are looking at not the 190 or the 228 level, 225 level. They need to see stress 100,000 up at 310, 325 level. We're a long way from that, but it's the vector, it's the movement up that matters.
The Fed likes to talk about the totality of the data, Lisa, so let's talk about the totality of the data ex non-farm payrolls. If you took payrolls out, The data last week, miss, week, and then bank lending data dreadful. That doesn't look good, does it?
Well, that gave people confidence that the Fed was going to cut by 100 basis points the next 10 months, and that all of a sudden, bang, everything is over with respect to tightening, and we're heading right back to zero. I mean, seriously, people were talking suddenly in a completely different light, and that's the reason why there are these whipsaws that are historic in the bond market, the most deep and liquid market out there. So here's the question. Have we truly reset? Are some of the pressures that we have seen truly disinflationary enough to remove inflation from the picture?
You've got some doubts about that. You've been asking that question over the last couple of days.
I know. I think that there is an increasing breach between the people who believe the Fed has to go further and those who think they should hold. And that unspoken reality is those that are more comfortable with inflation remaining higher for longer, and those who want to see it come down to 2% more rapidly. That's the difference.
And the zeitgeist of the last 48 hours is a reset on wage growth, and we've heard this from a number of our guests this morning, and you can take the statistics and make whatever you want from them, but I think a lot of Americans on radio and television right now would say, you know what, there was that moment, that glimmer of substantial nominal wage growth. It's vapored in the last 3 months.
We'll be with you through the next couple of hours, continuing to cover some of these themes. Coming up on an extended version of Bloomberg Surveillance for the next 2 hours or so. Gita Gopinath of the International Monetary Fund joining us in the next 10 minutes. Paolo Gentiloni of the European Commission. Raghu Raja of the University of Chicago Booth School. Tom, formerly, of course, of the central bank in India.
Timely as well in the setup for the equity markets here. It does dovetail completely into the equity markets. Why don't you bring in our esteemed guest for the Thursday adjustment?
Mike Wilson, the Chief U.S. Equity Strategist and Chief Investment Officer over at Morgan Stanley, joins us right now. Mike, wonderful to have you with us on the program. It's always good to see you, buddy. Let's talk about what we're going to hear tomorrow. Bank earnings. Earnings season has arrived. Mike, is this the one where they have to tank guidance because of what we've seen develop over the last month?
Hey, good morning, guys. Good to see you as usual. Look, I think that this earnings season will bring what it's been bringing the whole time. I mean, I don't think it's that different. We're going to see earnings come down again for the second quarter, right? We're going to jump over this lowered bar that has come down by about 7% for the first quarter. That's S&P overall. And I do think the banks are going to be, a greater center of attention for obvious reasons. And I think the more important commentary from the banks is going to be, what are they doing with their lending standards? How are they thinking about credit, creation, even more so than what they guide to? Okay. I think those stocks have been hit pretty hard. In other words, they've already priced earnings degradation for the banks. Our focus now as equity strategists is, what's the impact going to be on the broader economy? Because that part of the market is holding up. Small cap stocks have obviously taken it on the chin. Anything that needs capital on a regular basis has been punished. But, the S&P 500 is hanging around as, people rotate to other areas. But look, if we're going to have a sharp, contraction in credit availability and a credit crunch, as I expect over the next 12 months, then, it's going to hit a broader group of stocks. And so, to me, the focus for me is going to be on, how does the rest of the market trade on the back of their commentary around credit creation?
Mike Wilson, do you partition to changing the weight of equities, or is there an immediate efficacy to go to all cash or mostly cash? How do you split the two?
Well, first of all, we would never recommend to individual investors or asset owners to go to 100% cash. I mean, that's not a practical strategy for anybody, because you could be wrong in your assumptions and nobody can predict the future. But more importantly, that's not the environment we envision for the next several years. So we've had this view for a long time, as you guys know. We're in the kind of boom bust boom camp, which means that after we get through this slowdown that we're going through and may lead to recession and slowdown in various parts of the economy, there's going to be another boom to look forward to. And so I think this is one of the reasons why the equity market has not given it up yet, because I think people kind of agree with that view that we've had, and they're looking forward. They're saying, look, I don't want to miss the next upturn. We're willing to miss some of that more than other people, because we think the pullback will be more significant. But we don't go 100% cash, Tom. That would be impractical. But we have a high percentage of cash right now because you're getting paid to hold it.
Given the fact, Mike, that you have seen such resilience in the market, even in the face of what you said already, is what we have been seeing, which is relatively weak earnings. Have you revised upward your target for the S&P, where, say, the 3,200 bear case isn't really at play anymore?
Well, look, the way we look at the world and the markets is we have a sort of a 12-month view, and then we have a shorter term kind of tactical view. And on the sort of year-end target prices, we haven't budged those because we think those are still accurate. 3,900 is our base case for year-end, 4,200 bull case, and then a 3,600 bear case. Those are in place. Okay, those have not changed. The tactical trading path, what we've gotten wrong this year is the timing of it. We don't think the path is necessarily wrong. We put those targets of 3,000 and 3,300 for a trough for this cycle in May of last year. Okay, so that has not changed. But calling the price and the time, I mean, it's hard enough to get one right. To get both right, I think, is tricky. So we've been wrong on the timing for sure, but it doesn't change our view that low end of the range, that path to 3,900, we think still goes through kind of low 3,000s ultimately.
How difficult has it made your job, Mike, to see the volatility in the rates market persist to the same degree that we've seen over the past few months?
Well, I mean, I think rate volatility leads equity volatility. I mean, the rates market, I think, have moved away from the equity market view that the banking stress is going to lead to a credit crunch and probably a situation where the Fed's cutting rates because there's a recession, and the equity market is not priced at all. So you can place your bets. Who do you want to kind of lean with? We're in the earnings recession camp. So whether we have an economic recession or not, I think isn't as important as the earnings recession, and we're highly confident now that that's going to happen. That the earnings situation is way worse than what the consensus thinks, which is more in line with what we've been saying all along. And the banking stress only makes us more confident in that view.
So, Mike, to get specific here, and I don't want you to talk individual names, but if there's 7 stocks that are the stock market right now, do you sell? I mean, I'm assuming I'm not buying more of those right now, given a Mike Wilson view, but do you sell it and do something else? Do you put in a put play to protect the downside? What do you do if you've got gains in glorious big tech?
Well, look, first of all, those 7 stocks are not all tech companies, but what I would say is that they are cyclical companies in the sense that they are all tied to the economic outcome. And I think that is where we would differ from most people. We would say, look, these are high quality businesses, some of them, not all of them, but they're very tied to the economic outcome and the earnings growth situation that we see and their customers and their situation. So, look, if you have great gains in these various companies, it's no different than last year, Tom. Okay, you just want to make sure you don't have too much exposure to any particular areas of the market that we think get hurt in an economic slowdown that we're envisioning. And look, I mean, once again, that means holding more cash. It means not having concentrated positions in things that are probably extended. And for people who have tax consequences, which is a large part of your listening, audience, I would say, maybe you don't sell because you don't want to pay the tax if you believe in the intermediate term view. What I think the most important message, though, is just remember that the winners of the last cycle are typically not the winners of the next cycle. And these are very large market cap companies. So you do need to be selective and say, well, there's 7 or 8 here. I probably should think about 2 that make it, that not all 7 are going to make it as leaders in the next bull market.
Mike, just quickly here, we're at the IMF in DC, and I'm wondering how you incorporate some of these more official group projections in what you do.
Well, I don't want to sound, as if we ignore everything, but we have to focus on our own work. We can't rely on other people to do our forecasting for us. I think, to be honest, I think that is part of the issue we have in not just fixed income markets, but also in equity markets, is I think we've moved to a world where the dispersion of forecasting is very narrow. And this is why when the surprise comes, when the data comes in that's not in line with the tight forecast, the volatility moves can be greater. Okay, so we have our own forecast. We're very confident as we can be in this sort of fortune telling business that we're in. But we do our own work, and we have to do it that way.
Mike, that was perfect. Just perfectly answered.
Mike Wilson, beautifully.
Morgan Stanley. With Guido Gopinath just around the corner. Yeah. Mike Wilson, do you care about IMF forecasts?
Well, I'm curious.
Do you really give a damn what Guido Gopinath says?
Look, I think it's important to understand the divergence between Wall Street and some of the policymakers and how they're coming up with their projections.
Yeah, that's good. Guido Gopinath, the IMF, the Deputy Managing Director, joining us next. Equity futures on the S&P 500 unchanged. From the IMF's global headquarters in Washington, D.C. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The White House is rejecting an outlook for the economy by Federal Reserve staff. Fed minutes published on Wednesday said the staff sees a mild recession starting later this year. But a White House spokeswoman says that the data doesn't indicate that, pointing out recent numbers on jobs and consumer spending. Last week's production cuts by OPEC Plus nations will lead to a hefty oil shortfall that will grow as the year progresses. That's according to data from the cartel. A new report says world markets may be undersupplied by about 2 million barrels a day in the fourth quarter. In China, exports unexpectedly rose in March. They jumped 14.8% in U.S. dollar terms from a year earlier. Demand from Europe and most Asian countries improved. That boosts the economy's outlook and indicates global growth may be better than expected. A federal appeals court will allow limited access to the abortion pill. A 3-judge panel partly granted the Biden administration's request to put on hold a Texas court ruling that overturned FDA approval for the medication. On the other hand, it allowed restrictions on abortion that were lifted since 2016 to be reinstated. Delta Airlines is expecting profit this quarter to beat Wall Street estimates. The carrier sees steady bookings heading into the summer travel season. Delta also reiterated its full-year forecast of 15 to 20% revenue growth over 2022. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Financial conditions have tightened to some extent, but it's really in the banking sector that we have seen most of the tightening, and that could have consequences down the line for macro activity. Central banks have to fight inflation and have to keep monetary policy tight, but over time we do expect interest rates to come back down to our star, which we estimate to be similar to pre-COVID.
That's the call from the International Monetary Fund. That was Tobias Adrian, the IMF Director of Monetary and Capital Markets. Live from Washington, D.C. this morning. Good morning to you all. Counting you down to the opening bell about an hour and 14 minutes from now. Equity futures on the S&P 500 shaping up as follows. Positive just about by not even 1/10% on the S&P 500. The smallest of lifts up 0.05% this morning. Yields bleeding just a little bit higher by 4 basis points on a 10-year, 343.36. The news this morning, euro dollar reclaiming 110. On a euro against the US dollar, Tom, 110.18. We're positive here by 0.2%. Stronger euro in a mix, a weaker dollar.
And if we get the reach in euro, that's something we're not expecting. It's out, it's percolating among strategists, but I don't think it's in the zeitgeist right now. Truly weak dollar.
110.33, the previous intraday high of the year so far in early February. I think the same day the ECB met, and that was the day before that blowout jobs report. Do you remember that? North of 500K on payrolls.
And still there, 1 million U.S. jobs in the last 90 days.
It's been impressive.
It's a terrible economy.
3.5% unemployment.
It's in the IMF survey 5 years out. 500,000 gloom. It's there. Right now, an annual visit, as we do at these spring meetings, with Gita Gopinath, First Deputy Managing Director at the International Monetary Fund. And what she's done critically in the last 90 days is drive forward the discussion of crisis and monetary policy and how we're going to extract ourselves from this mess. Dr. Gopinath, thank you so much for joining this morning. You mentioned, buried in your wonderful essay, this scary idea that inflation becomes unanchored. Is inflation unanchored at this point?
No, not at this point. I think if you look at the data, it's squarely anchored in the US and in Europe and several other countries. That is not a concern right now.
The concern right now off of the 5-year forecast, it's your fault, we all know that, but the IMF 5-year forecast that we have is 3% or even lower. The World Bank even set a little bit lower, means a disinflation. It means a lower rate regime. If we have an unanchored or an anchored disinflation, does that lead to financial stability within your forecast?
If inflation expectations de-anchor, there are multiple problems associated with that. Firstly, interest rates go up. Policy rates have to rise much faster to bring inflation down. And that can generate much greater financial stress than we have seen, with consequences not just for the country where the tightening is happening, but if you're a large economy, with spillovers to the rest of the world. So that could be very consequential. And it's one of the downside scenarios we have in our World Economic Outlook, which is if interest rates have to go up much faster and you have much more tightening, you could end up with global growth going as low as, say, 1%, which would be very bad.
So what is the nominal GDP separation of the IMF 5-year forecast? Is it for a dropping disinflation, a lower inflation, and with it lower real GDP, bringing us down to a truly subdued nominal GDP?
No, we have, our expectation is that inflation will be conquered over time. It's not going to happen immediately, but if you go into 2024, you're going to see inflation around the world getting much closer to central bank targets. Real growth is going to slow also because we don't have any Chinas anymore that are growing at very high rates. So for the global economy as a whole, we don't have very large engines of growth. So that's generating the weakness in real growth, also because we have aging demographics. So unless we can find a way to raise productivity, we are going to struggle with low growth.
How controversial has your call been that inflation is going to get back down to where it was, close to pre-pandemic even, by 2024?
If you look at forecasts and if you look at market expectations in the U.S., you see an even more rapid fall in inflation that's expected. So we're actually on the side of being a little more cautious about how long it's going to take to bring inflation down. But we think the policies will work. There's been some very substantial increase in interest rates. We are seeing now that show up in terms of high-frequency data, the slowing of the economy, and we think that will bring down inflation. But it will take time.
Do you think that the balance of risk has shifted since what we saw with Silicon Valley Bank and with some of the other banking institutions and the huge drop-off in lending that we've seen peripherally in initial data, that the balance of risks has shifted to perhaps have monetary officials be a little less aggressive when it comes to rate hikes and to err on the side of pausing or even cutting?
As always, central banks need to take into account how economic conditions look. And with the financial stress, you've had a tightening in financial conditions. Bank lending standards have tightened. Smaller banks' credit has weakened. And that will slow the economy down to some extent, which is why central banks may have to do less. But again, I think we're still waiting for more data to show up to know exactly how much of an effect that's had.
Gita, there's a bit of tension between what the IMF has communicated this week and what politicians have responded with. Chancellor Hunt told us yesterday that he disagrees with your forecast. He's entitled to disagree with it. We spoke to Tobias Adrian literally in the last hour, and he said he sees evidence of lending, bank lending, contracting in America. Secretary Yellen says she doesn't see evidence of that. How do you explain the daylight between what your institution is saying and what politicians are saying back?
So firstly, I think if you look at the numbers, we're not that far apart, right? So for instance, in the case of the UK, I think what Jeremy Hunt would recognize is that we've actually had a substantial upgrade for UK for this year. It's just that we haven't gone as high as maybe some of the other forecasts are, but we've actually seen things turn out better than expected in the UK. In the case of credit conditions, again, I think the difference is that Tobias was pointing to all of credit supply, not just from the large banks. And so you see that in the smaller banks, you see certainly credit supply slowing. But if you look at the large banks, indeed, credit is holding up.
So you don't believe the Treasury Secretary is misleading us when she says things like she doesn't see evidence of bank lending contracting?
I think that's the description that, especially if you look at large banks, you are seeing credit holding up is an accurate representation, again, of the data at this point.
I look at where we are, and I wonder of the textbooks and the theory that's out there. It seems like everybody's post-pandemic, supply-driven dynamics making it up as they go. And the day-to-day Gopinath grind of putting together the Blue Book, the World Economic Outlook, how much are you relying on a traditional economics versus going, it's a whole new world after all?
Well, I think there are parts that are new, and then there are parts that are old and stay the same. So we're using a combination of models, but also going beyond.
Is our start a valid model right now? You and I are going to be with Olivier Blanchard tomorrow. He's trumpeting the dynamics of our start. Is it useful? Is there an efficacy to traditional John Williams economics thing?
I think it's a very useful input in thinking about how to fashion monetary policy and also fiscal policy. I think, it's an input. That cannot be the only thing one is focused on. I think that's what the pandemic and the war has taught us.
A lot of people say that this group of meetings is somewhat different in nature than previous ones, just because we feel like we're on the precipice of some sort of turning point, either back to what we came from or something new. How would you characterize it in terms of how these meetings are different?
I think this meeting is different in the extent that I think we are in this period where, after all the monetary policy tightening that's happened, we are seeing the effect of it, because we know all this tightening works with a lag. So I think this is the lag, and we're seeing it play out now. There are concerns about how this could play out. As of now, financial policy tools have worked well in being able to calm markets, but there are risks that are out there. The second aspect is we are looking at a period where growth in the world is not going to go back to the 3.8% it used to be, but more 3%. And lastly, we have many vulnerable economies around the world with very high levels of debt and could be in debt distress. So, I think we have to all, first of all, recognize that the world economy did better than expected last year. It showed much stronger resilience. We still have tight labor markets. Consumption spending is still holding up. But that said, the balance of risks are squarely to the downside.
That last point is so important. Geeta Gopinath of the IMF. Geeta, thank you. As always, it's good to catch up and good to see you in person. Tom, the resilience of the US labour market, to be specific, has been a standout, I would say, over the last 6 months for sure.
Without question, and all those statistics matter. Many say these weekly claims are front and center.
Jobless claims up next from Washington. This is Bloomberg.
We have only 8% of the ocean protected today, and our Earthshot is, as Patty said, 30 by 30. 30% of the ocean, at least, 30% of the ocean protected by 2030. And we know that if we protect the right 30%, not only we will prevent the extinction of many marine species, but also we will produce more fish. There's going to be, these protected areas are going to produce a spillover that will exceed the foregone catch. So we're going to have more fish to eat, food security, livelihoods for people. And we know that for every dollar that we invest in a protected area, in a marine reserve, that produces $10 in economic output and creates more jobs. So it's a triple win for marine life, for food security, and for climate, and of course, for the economy. So that's the goal, the mission.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Jobless claims data in America about 20 seconds or so away, live from Washington, D.C. this morning. Good morning to you all. Welcome to the program. Some more economic data just around the corner. Mike McKee's going to break that down for you. Going into it, equity futures shaping up as follows on the S&P 500, positive by a little more than 0.1%. Yields a little bit higher by 2 or 3 basis points. A 10-year yield this morning, 341.86, and euro dollar reclaiming 110. Let's get some of that economic data for you. We can cross over to Mike McKee. Hey, Mike.
Well, John, we seem to be seeing the same pattern in jobless claims that we saw before last week, with unemployment claims, first-time claims up 239,000. Remember, last week it was initially reported as 228,000, and that is now over the previous, it is unrevised. So basically, we're seeing claims in a range. Remember, last week, the Labor Department adjusted the seasonal adjustment factors to try to get some of the pandemic distortions out, and that pushed us up by about 48,000. But if we're staying at the same level here, we're not seeing a major increase in claims, and so it tells sort of the same story, that the labor market is doing okay. Continuing claims actually fall 1,810,000 from 1,823,000. So stability in the labor market from claims. And the other number out this morning is PPI, and this is good news on the Fed front, at least for those who think the Fed is getting something done. Final demand PPI, the headline number, comes down 0.5%. It was down 0.1% the prior month, and it was expected to come in flat. That puts the year-over-year number at 2.7%, down from 4.6%. The core rate of just subtracting food and energy, down 0.1%. The core rate, food, energy, and trade services, which is retailer, wholesaler margins, up just 0.1%. The core year-over-year is 3.4%, and the core, including trade, is 3.6%. Let me just mention quickly here, the year-over-year headline number revised up to 4.9% for the month of February, so an even bigger drop to 2.7%. We've really seen prices come down at the factory gate, as they would say, over the last month, and so this has got to be good news for the Fed. Doesn't necessarily translate directly into CPI, but it does suggest that inflation's going in the right direction.
True. Mike McKee, stay close. We'll run through this data and push it through the equity market and the bond market as well. A couple of ingredients here. On the labour market side, a bit softer. Jobless claims a little bit higher. You look at the disinflationary trends in PPI, you put those two ingredients together, and you get the smallest of bids in the bond market. Yields come back down just a little bit by a basis point or two on a 2-year to 394. On a 10-year, yields were a little bit higher, still just a touch higher by a single basis point. We take back some of that inversion on 2s10s. That spread negative 53 and up a couple of basis points on a session. If you want to check out the equity market off the back of this information, equity futures with the smallest of pops, Tom, off the back of this. Equity futures positive by, let's call it 0.25%.
The movement here is just as Mike McKee says, it's Fed friendly and it speaks to a disinflation. But Michael McKee, I've got to go back to you before we get to Vince Reinhart. How much information does this Fed need? I mean, I'm seeing the zeitgeist today framing wage growth that is a generalization has been cut in half. I'm seeing PPI is a generalization been cut in half, etc. Isn't that enough to make them change, as we heard from Goldman Sachs this morning?
Well, the Fed is going to want to have several months of this kind of data. It certainly is going in the right direction, and it's certainly playing out as they anticipated. The CPI yesterday with the big drop in rents, if that continues, we are going to see them get down into the threes perhaps by the end of the year, which is where they anticipated being. The PPI playing out as anticipated, but maybe even a little more so. The 2/3 of the decline in the index attributed to a drop in goods prices, which we knew had been happening. But listen to this, the index for final demand services fell 0.3%. Services was the area that the Fed is most worried about. So we are seeing prices come off the boil. The question is, does it continue, and does that stabilize wages?
Mike McKee, thank you, sir. Let's return to those markets. Equity futures on the S&P 500 off the back of the higher than expected jobless claims, positive 0.2%. I talked about that small move at the front of the yield curve, the 2-year yield coming in by not even a basis point now, but the move in the FX market just continues to stick. So literally in the last 60 seconds or so, 110.43, the previous intraday high of the year, 110.33, which is where we are right now, but moments ago, Tom, 110.43 on euro dollar. That's euro strength, dollar weakness. That's the strongest euro against the dollar of the year so far.
And while you were looking at that, I was trying. John and I do things together, folks. I was triangulating the yen, and we're not where euro is stronger through yen, which is a 147. Dare I say a 148 yen per euro. We're not there yet, but as you say, we're buttressed right up in that case on resistance.
At least they're breathing some life into that dollar weakness story with this data.
That this really is about dollar weakness. It's not necessarily about euro strength. And you're seeing, if you look at the Bloomberg Dollar Index, you see it close to the weakest level of the year. But if you could see that DXY goes back to also April of 2022. So this is a dollar weakness type of story.
Joining us now, and really well-timed off this economic data, is Vincent Reinhart, DeSay's chief economist at Dreyfus and Mellon. Barely describes his contribution to the Federal Reserve System. As head of research for Alan Greenspan for years and years, I can make sure he was a director of adverbs at the Federal Reserve. Vincent, thank you so much for joining us. There is that word out there, suddenly. And you and I know that when you get slowdowns, they usually happen suddenly. Are we at the beginning or the middle of suddenly for this Fed?
I think we're turning the corner towards suddenly, and we're not quite sure what's around the other, down the end of the block. The plain fact is that business cycle is uneven, irregular, a word you would like, quite dynamically driven. And when the unemployment rate starts rising, it tends to keep rising. You don't see it at first, you just see the dribs and the drabs, and then it happens all at once. That's how you could have the Federal Reserve staff forecasting a mild recession, even as we're getting data like Mike just reported. Pretty good. An economy that still has some momentum.
Right. Vincent Reinhart, Orphanides at the Fed 21 years ago, writing about the great inflation. We have had a sudden pandemic-driven great inflation. Can you state that the great inflation of the last 2 years, 3 years is over?
I got the headline you kept repeating, inflation is halved, but I keep having to remember where it started, 9%. We can't declare victory yet. The great inflation isn't over until the Fed says it is, because they don't need to raise rates anymore. Once we got a
connection
run in which inflation is close to goal and people don't care much about inflation, then it's behind us.
Well, Vincent, let's talk about what threshold it will be okay for inflation to fall down to. Are we seeing a greater acceptance, perhaps in backroom discussions, of a 3% inflation rate rather than, say, a 2% target?
I think that's the real risk, that the Fed declares victory too early because it's harder to do otherwise. Chair Powell says 2% is the goal. I'm inclined to believe him. That's his definition of price stability. But it will get harder from here on as the unemployment rate starts rising, as inflation is no longer as a material threat to economic expansion and people's well-being. I think you raise the issue. What happens in about 3-4 months when we get another string of good readings on inflation and troubling readings on unemployment? The Fed may declare victory. The problem is not that 2% is immutable. They didn't really have a great discussion of defining price stability as 2%. It's, however, having drawn the line in the sand, you lose credibility if you don't act as it is important.
So, Vincent, we're here at the IMF in Washington, D.C. at the spring meetings, and there is a belief here that inflation will naturally gravitate back to the pre-pandemic levels and that monetary policy will return also to similar types of ultra-low rates. Do you disagree? Do you think that there is a structural component to inflation that is underappreciated in some of these estimates and, frankly, baked into the market?
So I think there's a couple things going on. The IMF and a lot of analysts think we'll go back to the new normal or the old new normal. I'm running out of adjectives there. And rates will be low. That's possible, but look, for most of history, rates were higher. The anomaly was having a Fed-driven lower for longer episode that suppressed nominal interest rates and kept the real federal funds rate negative. We've broken out of that.
Yeah.
Not obvious we can get back to it.
Vince Reinhart of Dreyfus and Mellon. Vince, wonderful to have your perspective and that view as well, pushing back against some of the views here at the International Monetary Fund, right here at the headquarters of the IMF, and this is their view.
Yeah.
Somehow rates go back to this pre-pandemic story. And to Vince's point, it was the last 10 years that were the aberration, the last decade. That was the new normal, so to speak, and Vince is suggesting that maybe we go back to the
On an institutional basis, he's always going to support his Fed, and believe me, folks, it was Vincent Reinhart's Fed. The research capability they put together was first rate, but I agree with you. Yeah, they're making forecasts at the IMF, but institutions have to live it, and the institutions just aren't there yet, looking out to 25, a Draghi 25, or dare I say even 24. They're not there yet.
Let's just recap some of the data. If you are just tuning in, welcome to the program. So what we have here is jobless claims a little bit higher than expected, 239,000. The estimate, 235. PPI, factory gate inflation. PPI, Lisa, falling in March by the most since the start of the pandemic. That's the lead paragraph from Reed Pickett here at Bloomberg this morning.
And that really is the lead for the market reaction as well, where you see yields marginally lower and you have this sort of, tepid pop in equities, but it's not overwhelmingly excited because, frankly, we are seeing weakness in the economy. Does this read through to CPI? Is this enough disinflation? Yep. I mean, we knew that there would be disinflation, but where does it go?
There's a big question in Washington. Does Europe have a coherent view on China? Coming up next, Paolo Gentiloni, the EU Commissioner for the Economy and Financial Affairs. That conversation up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Fed officials feel they need to do a little more to tame inflation and are leaning toward another interest rate hike next month. That's according to minutes from their March meeting. This despite forecasts from Fed staff advisors that say there will be a mild recession later this year. Another missile launch from North Korea. A suspected intercontinental ballistic missile was fired toward waters off Japan's northern island of Hokkaido. That prompted a brief warning from residents to take shelter. South Korea says it's possible that North Korea may have tested a new type of solid fuel missile. There's a report on the alleged leaker of those U.S. intelligence secrets. According to the Washington Post, it's a young gun enthusiast who worked on a military base and shared the classified documents with a group on Discord, an online platform that's used by gamers. He was known as OG and told the group he spent some time inside a secure facility. Discord says it's cooperating with authorities. And SoftBank is cashing in on its long-held stake in Alibaba. It sold $7.3 billion in shares of the Chinese internet giant this year. That's after selling billions more in shares last year. SoftBank once owned a third of Alibaba. Most of that came from early $20 million investment in one venture capital's most famous bets. And Delta Airlines is expecting profit this quarter to beat Wall Street estimates. The carrier sees steady bookings heading into the summer travel season. Delta also reiterated its full-year forecast of 15 to 20% revenue growth over 2022. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Okay, so you're moving in on me, quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You've got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
In effect, the central banks were buying giant duration. And so what that meant is it distorted all world markets, and we're now in the workout phase. There'll have to be a normalization of interest rates. It means pressure on asset prices for a long period of time.
That was David Malpass, the president of the World Bank, joining us here at IMF HQ in Washington, D.C. From Washington this morning, good morning to you all. Also counting you down to the opening bell about 44 minutes from now, with equity futures on the S&P 500 positive by a third of 1%. Literally about 16 minutes ago, we had some economic data out of the United States. Jobless claims a little bit higher than expected. PPI, factory gate inflation coming in a little bit softer than expected. That breathing some life into the equity market, taking some life away from the US dollar. Euro dollar breaking out to 110.43 at one point, new intraday high for the year on the euro against the US dollar. Tom, right now 110.30. The euro stronger, dollar weaker, euro stronger by a third of 1%.
Giro Movie, we've been talking about it all morning in a weaker U.S. dollar and maybe where we'll be 3 months or even 3 years from now. There is a longer time frame here, but far more importantly is the outrageous demand of the Bloomberg surveillance team that we focus on what matters right now. And so as we introduce our next guest, John, I think it's just wonderful that Ted Lasso has taken an Italian play off AC Milan to bring a new character in. But the tensions, as I saw Real Madrid play Chelsea yesterday, and the tensions of your AC Milan, and is it Juventus is how you pronounce it?
Well, the commissioner supports Juventus, but ultimately I don't think he wants to talk about his beloved Juve this morning.
It may not be, but it shows the tensions that are out there
want to
right
keep
now,
our
the
guests
dynamics
on
of the
set.
moment.
There's good reason for that. Paolo Gentiloni joins us now, the EU Commissioner for Economy and Financial Affairs. Commissioner, good morning.
Good morning.
We won't talk about Juve, don't worry about it. I want
Next
to talk
time.
about something much more difficult. Let's start with this question. Does Europe have a coherent approach to China? And if you do, what is it?
Well, I think we do have. This is the obvious answer. It is evolved, this attitude, since 3-4 years. Our attitude until 3-4 years ago was the attitude of, well, we have important trade relations, and whatever they are, we will strengthen these trade relations. Now I think we are very clearly on the perspective to rebalance these trade relations, to also leave behind a certain ingenuity that we had in hoping that these trade relations in themselves would be in an equal treatment, in a level playing field, which was not completely the case. So we are still cooperating economically, but we have also a geopolitical perspective, which is, of course, quite different from China, and it is the perspective of our partners and US and the Western alliance.
If your view, Commissioner, is different to the view of the French president. I'll share some of his language with Politico. Over the weekend, he said the great risk that Europe faces is that it gets caught up in crises that are not ours. He's talking about China and Taiwan and potentially just following whatever the United States does. Do you agree with that sentiment?
No, I agree on the fact that we should avoid this kind of crisis. But of course, if this crisis occurs, we know which side we are in.
I look at Italy, and I have to bring this up, and in American football, this would be called an audible. I'm going to change gears here on what's unspoken. The stunning statistics, and you as former Prime Minister of Italy could speak to this, of a birth rate in Italy post-pandemic that takes you back to 1861. The demographic driving forces that we face at these meetings are enormous. Are we depeopling the Western world?
I think we run a risk. I think this risk is particularly clear in Europe, especially in Eastern Europe, but indeed also in my country and other European countries. How do we face this challenge? Well, I think we should continuously look to our perspective in a not only in a horizontal way. So, I mean, Europe and its big eastern neighbor, Europe and Russia.
Right, right.
We need a vertical way, knowing that Europe, the Mediterranean, the Arab world, Africa, this bloc will have in 2050 2.5 billion people, and we need cooperation, legal migration. This is, of course, joined with internal policies that are increasing demography. This is the solution.
Well,
also to the demographic challenge.
The European experiment forward has to be, and percolating out there is an optimism about a better nominal GDP for Europe. Do we still have eurosclerosis, or should I say the risks of eurosclerosis, or have you broken free of that, as John mentions, with a new relationship with China, among others?
Well, I think that, we love living in Europe. I think it's, we are proud of our values, our culture, but we should not think ourselves and if possible the world, to Europe as, well, what a beautiful place with such a good values, a wonderful culture, etc. Because Europe is also the place where innovation happens.
Are you seeing a new nominal GDP in Europe? Have you broken free from the Eurosclerosis theme of decades?
I think there is a chance to do so. Why there is this chance? Because I think for the first time, in this case, the European Union, is thinking itself as an actor on the global race to innovation, to clean technology, what in our Brussels language we call strategic actor on the global race to innovation, to clean technology, what in our Brussels language we call strategic autonomy, is something completely new for Europe. Our idea of the European economy was, until 3-4 years ago, the idea of a economic single market based on competition and open trade, full stop. Now, the European Union, with plans of strategic autonomy, is a European Union fighting for innovation.
Just quickly here, how much is that new vision at odds with the vision that the United States has in terms of a cohesive trade relationship with China and a cohesive trade relationship across the Atlantic?
Well, I think we should be recognizing the fact that we will have in the coming years a sort of race to clean technology in the world.
A race with the US?
A race among the economic global player.
A race for subsidies?
The problem is to avoid that this become a race for subsidies, and the risk is this, to avoid, is that this undermine the relation with our partners. I'm very optimistic from this point of view, because with the Americans, with Canada, with other countries, with Japan, we cooperate very well. Everyone recognizes that Europe has the right and the duty to provide security to its own supply chains of the future. I think that this is clear for all our partners. So the problem is how we participate to this race for clean technology without transforming it in a subsidies war and in a tension among partners, and without transforming this in a reduction of global trade. Difficult balance to find, but if we don't find this balance, if we don't have global trade for an economic bloc like the European Union, it's a big problem.
Commissioner, thank you.
Thank you very much.
Paolo Gentiloni there, the EU Commissioner for Economy and Financial Affairs. Tom, still making things happen in Europe, still difficult. Ask Macron about trying to change the retirement age. How's that gone?
The huge challenges in France speak of what would happen if they push it even further country to country.
We're counting it down to the opening bell from Washington, D.C. Up next is Jim Bianco, the president and founder of Bianco Research, with equity futures on the S&P positive by 0.4% from Washington. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is
It actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
So let's go inside the boardroom. Let's suppose you win a proxy fight and/or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom, okay? It's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This is Bloomberg.
The Fed worries about inflation. When nominal GDP growth is weak, they'll have a whole host of other problems to contend with.
I don't agree with the view that the Fed's going to be cutting rates by the end of the year.
You have a Federal Reserve that says we're not done hiking. We have more work to do.
I don't think we should feel comfortable that the worst is past us.
It is particularly a period of heightened uncertainty around the outlook.
This is Bloomberg Surveillance, live from the IMF spring meetings in Washington, D.C., with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Live from the nation's capital for our audience worldwide, counting you down to the opening bell over in New York City. Good morning to you all. An extended edition of Bloomberg Surveillance this morning from the global headquarters of the International Monetary Fund, live on TV and radio, alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Ferro. Just to give you a flavour of the price action going into the opening bell, equity futures on the S&P 500 just about positive here by 1/3%. A lift in the equity market off the back of higher than expected jobless claims again. Bit of a sign, an extra sign of softening in the labour market on top of a drop in PPI, the biggest drop in PPI going all the way back to the beginning of the pandemic. So yields lower, equities higher, dollar weaker, new intraday high for the year on euro dollar, 110.50. We are positive 0.5%. There is some real dollar weakness, Tom, in this market right now.
Moments ago on the plunge here in DXY, that blended large trading, euro 54% weighting to DXY, you're going to get a 100 handle on DXY Just in the last 10 days, that's a substantial 102 down to 101, a weaker dollar down to a 100 handle. We're almost there right now.
That's the data behind us. Let's talk about the data in front of us as well. Tomorrow morning, retail sales and bank earnings begin, so a really, really busy morning going into the opening bell. This hour, coming up this hour on Bloomberg TV and on Bloomberg Radio, Jim Bianco of Bianco Research, Richard Bernstein of Bernstein Advisors, Kristen Bidley of Citi Global Wealth Management, and we'll catch up with the brilliant Raghu Rajan, a good friend of Bloomberg Surveillance over the years, formerly, of course, the leader of the Indian Central Bank and now leader of the University of Chicago Bull School.
I'm very curious about his take on some of the issues that are highly controversial. People are kind of glossing over differences here, but there is a feeling that there is a heated debate of where we're going and how much pain is going to be necessary to get there, and also whether there is the political will to really cause that pain at a time when you start to see inflation impede some of the employment markets as well as some of the other factors that drive day-to-day decisions.
Washington's slowly waking up behind us, I have to say.
Yes, you could feel it.
Things get going at the International Monetary Fund at our headquarters for these spring meetings for the World Bank, IMF. Lisa, I have to say the theme so far, there is division between what the IMF says and how politicians respond to it. The IMF says X, and politician turns around and says Y. No, I don't agree with you.
So basically, you can take whatever data point you want and spin the story you want. So you could say, well, look, at least it's not going to be a super deep recession, and we're not going to have this, global malaise for a decade. So this is a positive thing. And by the way, we still have jobs, and so things are still chugging along. Or you could look at this and say, we're going to get a new, slower growth regime with a more stagflation-like kind of feel for a couple of years. And what that's going to fall into is going to feel different and less pleasant than what we had before.
To Jim Bianco's leadership on Twitter as we've gone through this banking crisis, he's been out front on, look at the BTMM screen. There's lots of 5%-ishes out there, but if you get wages to come in, PPI to come in, disinflation, dare I say, what's the trajectory down from 5%, if at all? That's a huge mystery right now.
At what cost?
Well,
that's the question.
Yeah.
At what cost?
I don't even think we understand the trajectory of disinflation that we see farther out the curve and certainly within the short-term space.
Jim Bianco with us now, the founder and president of Bianco Research. Jim, good to see you, buddy, as always. Let's talk about the data out 34 minutes ago. Just your initial response to it, Jim.
Yeah, that and the CPI yesterday, inflation has peaked, inflation is coming down, but that's not really the story. The story is, where are we going in the long run? Is CPI going to go all the way back to 2%? Is PPI going to support that we're going back to a long run rate of 2%? That's the real question. I'm in the camp, we're going to probably come up a little bit short of the 2% target. We've got a big base effect coming because May and June were big inflation numbers of last year. We dropped those off with lower numbers this year. And we might see the low of inflation at the June reading, which we get in July, and then started to see drift higher. So if we come up short of 2% and we start drifting higher in the second half of the year, that will embolden the Fed towards its aggressive policy of higher for longer.
So, Jim, can you talk a little bit about how much conviction you feel from Fed officials to get down to 2% and the pain required by keeping rates higher for a longer period of time?
Oh, I think the conviction with them is very high. I think it comes back to the meeting last year with President Biden in the Oval Office, where he pretty much pointed at Joe Biden. Joe Biden pointed at Jay Powell and said, it's his job to fix inflation, America. He's going to bring it down. And they're taking that very, very seriously. And they've got a target of 2%, and that's what they're gunning for. And there's going to be no backing off of that. So I suspect that, yeah, their conviction is going to stay there. They're going to go hike again. They're going to try and stay higher for longer. The only thing that gets in their way here is if we have some kind of a credit crunch and a big change in the economy in the second half of the year. And to that end, count me in those that think that there's a bimodal outcome. That's a fancy word for saying either the Fed is going to not cut rates at all for the rest of the year, or if they do start cutting rates, they could go 100 or 200 basis points. The expected outcome of that is 75 basis points, which is what the market is pricing in. That's why I said it's bimodal. Either there's going to be nothing or there's going to be a lot, and the market's kind of pricing in the midpoint of that.
Jim, it sounds like you agree with the IMF that we're heading back to an inflation type of environment that we had before the pandemic, and that monetary policy could go back to those ultra low rates once this blip is over. Is that right?
Sort of. I mean, monetary policy, like I said, if you cut it 100 or 200 basis points, you're still at 3%. So we're not going back to zero anytime soon. And I don't think the inflation rate, let's say on the long run rate, gets to 2%. It might get to 2% or lower if you have a recession, but then it rebounds with the recession as well. So yeah, the Fed will respond to that, but the response will not look like a pre-pandemic response of we're going to go back to zero, hold there for many years, and then go engage in money printing again. That era is over because we've got some inflation, and I think persistent inflation above 2%, and that'll limit the Fed as to what they can do. But they can still cut if we see a slowdown.
Jim, I want to go to your work through the pandemic. You've been hugely influential, particularly out on Twitter. And this morning, you tear apart the work from home certitude, the absolute mystery. It's out there. And I thought it was very comforting, Jim, to see you go after aging boomer managers like Fink and Diamond and say these guys are lonely. Is work from home going to work? And how does that change the American economy?
Oh, I think work from home has to work. And I think it's working in a lot of parts of the economy. Interestingly, where it is getting the biggest pushback is probably large banks and financial services firms headquartered in Manhattan. That is probably the hardest place you're seeing them push back from it across the country. And as you move left towards the West Coast and tech, it's the easiest to see work from home. And so it kind of goes all the way across the country in that point. Now, yeah, I think that this is a new evolution in the economy. And simply put, pre-pandemic, you were home 2 days a week, Saturday and Sunday. Post-pandemic, work from home, remote work, you're home 4 days a week, Saturday and Sunday, and you're in the office 3 days a week. If you double the amount of time you're home, you've changed your lifestyle. And that has been showing up in how the retailers have had a difficult time with their inventory over the last year and a half. They're trying to figure out what people buy because their lifestyles change. The economy's changed. We've had supply chain problems as well because a lot of things have changed. This is all part of this post-pandemic economy.
And there's one thing, Jim, we still haven't reckoned with. Commercial real estate, residential real estate in cities. You look at the prices still, New York City. Tom, we talk about this so often. They're still phenomenally
median rent high.
Have they adjusted?
12-month median adjusted rent in New York City. You need $48,000 a year cash to survive at the median level in New York City.
Jim Bianco, how do you make sense of that?
Well, I think one is a lifestyle. They're both lifestyle changes as well, because to the extent that there is work from home, or let's call it remote work. I don't want to say that everybody's 0-5 at home 5 days a week. There are people that like the urban lifestyle, so they move into big cities like Manhattan, and there is going to be a demand to live there, but maybe not go to Midtown to an office in a big tower like we used to have as well. So you have to break down commercial real estate into residential and into office, and they're two very different markets right now. The office market has been struggling a lot more than the residential market.
Hey, Jim, smart, as always. Jim Bianco on Form, president of Bianco Research, on the latest gun into the opening battle about 20 minutes from now. Equity futures positive a third of 1%. If you are just tuning in, welcome to the program. Tom, I think we need to talk about this. The banks want people to go back to work. Okay. The problem is there are people that are living outside of New York City and they've figured out life's pretty good. Working from home 3 times a week, and I don't have to come to New York City and spend the money. So what's the solution?
The solution, without question, is a 2-tier salary compensation system. Nobody wants to talk about it.
Let's talk about it.
I'm in the surveillance timeout chair right now, but at some point, and it can go 4 ways on a game theory basis. Either compensation, work from home is going to go down. Maybe it's level. Maybe it goes up. But there's going to be a premium to be Bramo and have to haul into the office every morning.
If you believe having people in the office contributes positively to culture, then you might have to pay for it.
Talk to Bramo. You know where I am on this.
Bottom line, Lisa, we can talk about it. I think we're all on the same page about this. If you want people to live in New York City, if you want them to come into the office 5 times a week, then there must be a way of making sure they're compensated for that relative to the people who have chosen not to come into the office and live in the suburbs and have this wonderful life where they have space and family time
You're
and sit
talking
down.
about 7% of the Americans.
I'm trying to build a studio in the garage
Evidently,
in Connecticut.
I feel like there's something happening here.
That's the point.
Honestly, look, this is going to be an issue, but Mondays and Fridays, I think, are out of the office, period. And I think that Tuesday, Wednesday, and Thursday are in the office, and
My
that is the new
problem is
model.
it's an elite discussion. The number one thing they got to solve that we've learned out of this is the child care disaster in America.
Yeah.
That's the number one issue that has to get solved.
Richard Bernstein is wondering whether we'll talk about this and not markets. We'll decide shortly. Richard Bernstein, the CEO and CIO of RB Advisors, joining us up next.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. U.S. producer prices fell in March by the most since the start of the pandemic. The producer price index decreased 0.5% from the previous. Now, for the year, the PPI rose 2.7%, the smallest gain in more than 2 years. All of this is likely to weaken overall inflationary pressures in the coming months. Meanwhile, the White House is rejecting an outlook for the economy by the Federal Reserve staff. Fed minutes published on Wednesday said the staff sees a mild recession starting later this year. But a White House spokeswoman said the data doesn't indicate that, pointing out recent numbers on jobs and consumer spending. Last week's production cuts by OPEC Plus nations will lead to a hefty oil shortfall that will grow as the year progresses. That's according to data from the cartel. A new report says world markets may be undersupplied by almost 2 million barrels a day in the fourth quarter. A federal appeals court will limit access to the abortion pill. A 3-judge panel partly granted the Biden administration's request to put on hold the Texas court ruling that overturned FDA approval of the medication. On the other hand, it allowed restrictions on abortion that were lifted since 2016 to be reinstated. Delta Airlines is expecting profit this quarter to beat Wall Street estimates. The carrier sees steady bookings heading into the summer travel season. Delta also reiterated its full-year forecast of 15% to 20% revenue growth over 2022. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Names in business are on Bloomberg.
Do you foresee a future where JP Morgan could potentially re-enter the Russian market?
One day, maybe, but it's very possible that won't happen in our lifetime.
Nobody covers business like Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep real World Cup. This is a 3.
As the economic picture does. The BOK is getting ready to make a decision.
We are in this period where, after all the monetary policy tightening that's happened, we are seeing the effect of it because we know all this tightening works with a lag. We are looking at a period where growth in the world is not going to go back to the 3.8% it used to be, but more 3%.
Gita Gopinath there, the first Deputy Managing Director at the IMF, joining us in Washington a little bit earlier on this morning. Good morning to you. As we count you down to the opening bell about 14 minutes from now, we did have some data out a little bit earlier. Jobless claims a bit softer. The labour market softening may be based on that. I don't know. It's a couple of weeks to this, so keep an eye on it. Outside of that, the PPI data came in a downside surprise. The biggest drop we've seen, the largest contraction in PPI going back to since the pandemic actually started. Supposedly, could be bullish if it continues, if we don't have to pay for it on the GDP side or in the labour market. Equity futures positive by 0.25%, Tom, on the S&P. Yields a little bit lower by a single basis point on a 10-year, back below 340, 337.90. And this is the standout this morning, isn't it? It's the dollar weakness, the euro strength, euro-dollar positive 0.5%. Yeah. Let's call it 110.50 on euro-dollar, taking out the intraday highs of the years from back in February.
The standout for me is the quality of guests we've had. To have the former Prime Minister of Italy with us, to have John Lipsky with us, Dr. Gopinath, and others. And with Bianco, we haven't let up on the market coverage either. You got to do that. I mean,
earnings tomorrow, retail sales tomorrow.
We're going to do that right now, and if you are part of Global Wall Street, you know this. If you're not, on radio and television, lean forward for Richard Bernstein to say he's the CEO, CIO, see this, see that of Richard Bernstein Advisors doesn't describe what he did 30 years ago. He launched a book, Style Investing, that was so important, you bought it and walked around with it to be cool, even if you didn't read it. Joining us on Value and Unique Value, Richard Bernstein. Richard, I want to cut to the chase. 28 years ago, when you wrote Style Investing, Apple Computer and 4 other of their kin weren't 25% of the market. How do you do value investing, Bernstein investing, with the predominance of those major big tech cap stocks?
Well, Tom, good morning. And I think what your comment kind of reflects in the market is the effects of the secular period of disinflation and the secular period of falling interest rates. What we're really talking about are long duration equities. And so just as long duration bonds were the biggest beneficiaries of this extended period of secular disinflation, so were long duration equities. So that's why I think those types of companies have expanded so much within the United States. But I do think that we reached the kind of pinnacle of all this, several months ago when individual investors began to take a flyer on every speculative long duration name you could ever think of. I think that was the closing bell, really, so to speak, on that theme.
How do you describe constructive value right now? What are the attributes or factors of value that will make money 3 to 5 years out?
So Tom, we've coined this phrase that the economy, the global economy, and the U.S. economy especially, is moving from an environment of cute wiener dogs in the metaverse to real productive assets. That we think that is the long-term theme, 5, 10, 15, 20 years, that we are going to face a period of secular inflation, not massive, but let's say 3% instead of 1.5 to 2. And that will benefit assets that either benefit from inflation or fight inflation. Right now, those would be mostly characterized as value investments.
Richard, as we move from two wiener dogs in the metaverse to something that is perhaps more tangible, how does that affect where we're going to end up with respect to inflation? We're here at the World Bank, people are the IMF, and people are talking about inflation going back to where it was pre-pandemic. Do you agree?
I really don't think that's going to happen. And if it does happen, it will be for a brief moment because the economy is exceptionally weak. Right? I don't think we're going to have a nice soft landing and no inflation. I think we'll have no inflation, maybe, but that will mean we have a pretty good recession. If we don't get a pretty good recession, you're going to have inflation. But I think Lisa, the number one factor that caused all this disinflation and this overhang of disinflation in the financial markets was globalization. Globalization just consistently increased competition around the world. And we know when you increase competition, you put downward pressure on prices. It's hard to argue that globalization is still going to expand. I mean, maybe we are going to, all sing Kumbaya and we'll be like the old Coke commercial, holding hands and singing on a mountain somewhere. But I really don't think that's going to happen. And as globalization contracts, we should expect more inflation rather than less because we're going to reduce competition. Let me add one more thing to that. For the United States, that's critically important because of our trade deficit. Nobody cared about our trade deficit and our dependence on the rest of the world for goods while goods prices were deflating. But as it gets harder to find those goods, our trade deficit is going to be very, very important.
So, Richard, how is the market mispricing this? I mean, you talk about how a Fed pivot seems farther away than is currently thought. How mispriced are bonds and stocks, and which is worse?
So Lisa, I'll change this a little bit. I won't say bonds and stocks. I think the asset class that is grossly, and I'd say that with a capital G, grossly overpriced are cryptocurrencies. Cryptocurrencies are the ultimate speculative markets. There is nothing there. It is speculation purely for the sake of speculation. Something wild is going to happen in the future, but nobody knows what. Let's go take a wild one on this. That I think is the asset class that's most grossly overvalued. Stocks are more like a seesaw. We have this one group, which we could call tech, innovation, disruption, all the sexy stuff. They're overvalued as well, not as much as cryptocurrencies, but they're grossly overvalued. The rest of everything else, maybe we should ignore financials for a moment here. Everything else almost around the world is fair game from a value perspective.
Richard, what I hear from you, to put a bow on it, and great to catch up with you and listen to you as always, is that you think that the IMF is wrong. Is that right?
I think, look, I don't want to, nobody's right 100% of the time. I don't want to say they're wrong necessarily. I do disagree with their assessment that we're going to have some kind of soft landing and, inflation's going to subside and we're going to go back to where we were. I don't think we are going back to where we were. We're going into some new paradigm. I don't think anybody really knows exactly what that's going to look like, but it's not going to be where we were. And I would argue, Jonathan, the number one factor that's causing that is this contraction, this very gradual and slow contraction of globalization.
Richard Bernstein of RB Advisors. Thank you, Richard, as always, sir, for your input. The IMF in its outlook, in this piece that it put out early this week when it talked about going back to pre-pandemic interest rates, they acknowledged that that was a risk factor in their outlook, deglobalization.
Yes.
One of three, actually, and that was an important one, Tom.
The key one is fragmentation. When you talk about this with the managing director, that's the word that comes up. And they're overlaying their caution, unlike Wall Street, with a substantial geopolitical take. And what they're talking about, it doesn't go away. You got the Paris Club, Wigglesworth today in the FT, the Paris Club, the London Club. Do we need a Beijing Club? Is that where we're heading next?
And the conversation we've had increasingly, Lisa, over the last year or so is that there was some kind of secular component to this inflation story, that it would be stickier than some people expect. And that's not exactly backed up by what the IMF is communicating this week. In fact, they're saying entirely the opposite.
The interesting thing is it's not just the IMF. The market agrees with the IMF. As Gita Gopinath said, the market's even more aggressive than they are when it comes to how quickly the market is pricing in inflation coming down rapidly. So here's really the tension. How much conviction can you have to come out and say, this time is different, there is something new here, fight what's going on in markets, fight what the IMF is saying, and go the other way? How long can you stand to be wrong, potentially, if people are moving in the other direction?
I'd be in the camp of John Lipsky, which I would be a little humble about looking at the track record of how often I've been wrong on inflation. And as you say, it's the quickly part, it's the adverbs that are going to kill people here.
And the track record of this fund, which is hosting us this week, is not exactly great either. Richard's saying we're not going back. We're not going back to pre-pandemic rates. We're not going back to pre-pandemic leadership in the equity market, although that's where the leadership has been year to date. And this is the open debate right now. Kristen Biddley's going to weigh in on this, the head of North American investments over at Citi. She'll join us shortly. About 4 minutes away from the opening bell. Equity futures still with a lift, positive, following that data in America. PPI a bit softer, claims a little bit higher. Equities a little bit firmer, up 0.25% on the S&P 500. Live from Washington, your opening bell coming up next.
a book about YouTube now? Why did you do this project?
Yeah, YouTube is this kind of a sleeping giant in social media. Someone described it as like this iceberg that no one ever really talks about as much for a variety of reasons. I see YouTube as both the past and now future of social media, and it was the first company to pay online broadcasters and invented the creator economy. And now we're seeing with TikTok, Instagram, Snapchat are all moving in this direction. Social media is no longer your friends and family and your acquaintances. It is influencers. It is celebrity. It is a game built around commerce. And this is a world that YouTube very much created.
Should we be telling Odd Lots listeners to like, comment, and subscribe? Other podcasts do that.
I mean, it's an effective call to action.
All right, everyone, like, comment, and subscribe on Odd Lots wherever you find it.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
23 seconds away from the opening bell in New York City. From Washington, D.C. this morning, good morning to you all. As we count you down to the opening bell, here's a flavour of the price action. Equity futures positive, 1/3%. A lift following the economic data we got about an hour ago on the Nasdaq, up 0.6%. There is your opening bell. Switch on the board and get to the bond market. Take a look at this in the bond market. Yields shaping up as follows. Unchanged, 338.87. But in the FX market, what a move. 110.50 on euro dollar, a new intraday high for the year on euro dollar, 110.57. The Y is in the economic data of 60 minutes ago. Jobless claims a little bit higher than anticipated. PPI a little bit softer than anticipated. If you wanted a reason or two for the Fed to back away, a bit of softening in the labour market, a bit of a sign of disinflationary trends taking hold. You got both of them about an hour ago. How much weight you put on them is for you to decide. So there you go. There's the opening bell. Let's get straight into the market. 30 seconds into the session, your equity market shaping up as follows on the S&P 500, firmer by 0.25% at least. The Nasdaq up by about 0.6% this morning.
Yeah, I'm focused on the airlines this morning when you take a look at what is moving, just simply because we did get those Delta earnings earlier, and they were better than expected when it comes to second quarter projections, and really that seems to be the focus. And you can see after the initial pop, the shares are actually lower, which really is interesting to me, given that we saw them up about 3% half a second ago. And this comes as there is this real tension between people booking so many flights and paying a ton for them, making good margins and expected to, and yet what do you get with consumer discretionaries if you do get some sort of slowdown, as we see reflected in a tick up in layoffs and a tick up in what the pressures are for the economy. You can see, though, that there still are some gains being held on to American Airlines, up about 0.8%, and United up about 0.8% as well. There are other stocks that are moving, but you know what I find interesting?
Sure.
Financials aren't moving much. They're pretty much unchanged, maybe up a little bit ahead of the earnings tomorrow. And so I'm really trying to see whether there's going to be some sort of pre-look or gaming out of what we're going to get tomorrow.
I can't wait to go through the numbers from the financials, Tom. Not just because I think a lot of people are interested because of the shock of the last month. I'm actually looking to the big names to see if there are any positives there for them and how embarrassed they might be of some of the gains they've got over the last 30 days from some of the tension we've seen with the smaller players, the regionals.
What I'm going to watch is what they genetically do, like lemmings off a cliff. Oops, things are uncertain. We need to cut costs. And I'm really interested in the cut cost vision. There'll be lots of verbiage to avoid that language, but I really wonder how tight the ship's going to be at some of these major players.
One question I've had, Tom, over the last couple of weeks, it was too soon for the Federal Reserve to change its outlook. Its outlook in the summary of economic projections was largely unchanged at its last meeting from the meeting previous to that 2 meetings ago when they last delivered their quarterly outlook. If it was too soon for them, is it too soon for the C-suite to change their outlook in the financials, given the shock we've had, Lisa, over the last 4 weeks?
They'll be out front of the Fed.
I would agree, but I also think we've heard some anecdotal discussions about how credit card spending has come down. We've heard anecdotal conversations about how banks themselves are increasing their credit standards. How much do they increase their credit standards? Are they reducing what they lend? Are they increasing some of the credit loss provisions? What are they doing with some of the loans still hanging out on their books, say like Twitter? I mean, I'm just curious what they indicate as they deliver earnings.
This industry group, Tom, has said repeatedly, quarter after quarter, for a couple of years now, that the consumer's really resilient. It's got this massive cushion, a big pool of savings, and let's see if we've taken a big chip away at that in the last quarter.
Some of the uncertainty here that we have into the second quarter, dare I say, do we have a vision to Labor Day? I doubt it. Someone who does have a vision to Labor Day is Kristen Bitterly, head of North American Investments at Citigroup. How do you rewrite the year-end outlook, Kristen, right now? What is new in the Citigroup outlook?
You know what I think is really interesting, Tom? We have been one of the few firms that has not rewritten our outlook once or multiple times in 2023. We started this year with the belief that we would see a recession and that we would see an earnings contraction of upwards of about 10%. And so that is something that's based on not what we've seen year to date, but actually all of the cumulative impact of this tightening that if you look at any one individual data point, and I know you guys were talking about this a little bit earlier, I think you can start to explain it away or to try to find a narrative. But when you look at all of the leading indicators and all of the data points that we have seen that have shown that we are seeing a decline in economic growth, that still keeps us in our defensive positioning, which is where we started the year and where we're holding on.
Right. Well, you've got economists looking for some form of rate stability, or dare I say, a set of rate increases as well. How do equities compete with the Citigroup outlook on what short rates will do?
And this is, I think, the most interesting story that we have seen is the resiliency, or I should say the quote unquote resiliency of equity markets. All the volatility has been in the rates market, as you well know, and the repricing of monetary policy numerous times. I think when we break down, though, the story within the equity markets, it is interesting because 92% of the gains that we've seen are really attributed to 7 companies, of which about a quarter of that is Apple. When we break down what's been happening under the surface, just looking at Q4 earnings of last year as a little bit of a forecast, Q4 earnings, we had 7 sectors already in profits recessions, and that was up from 4 sectors actually in Q3. And so we're already starting to see some breaks under the surface in terms of impacts on profitability, even though the index is telling us a much different story.
So, Kristen, with that in mind, going into earnings season, the big banks on deck reporting tomorrow, starting with JP Morgan and others. Just how low is the bar? How low has that bar been set going into earnings season?
I think the bar is actually pretty low. So obviously there's not a lot of expectation here in Q2 earnings. But I think what you guys were just talking about prior to this segment becomes critically important. For bank earnings, and especially when we're looking at the large banks, I do think that when you look at some of the stock price performance already and what's been priced in, a lot of we know what's going to happen in terms of whether you're looking at pressures within investment banking, deal-making revenues, the limited activity in equity IPOs. And so I think a lot of the discussion is really going to be around what is the forward guidance and what is really the environment that we're talking about, not from a liquidity standpoint, not from a profitability standpoint, but actually about a credit creation and credit availability standpoint, which obviously has important implications for the economy.
So how are you going to use this, Kristen? I mean, we talk about how this is going to be the key data point possibly of the week. Forget CPI, forget PPI, forget jobless claims. It's going to be what JP Morgan's Jamie Dimon has to say about what he's seeing with respect to lending conditions. From your vantage point, how does that change what you do Monday?
So on Monday, I don't think there's a material change in terms of our portfolios because what is going to happen ultimately is we believe that, again, this is not an additive effect of all of these different indicators. There's actually a multiplier effect, and there's a little bit of a cycle that we will see. So this idea of us being defensively positioned, and one of the things that I have to mention is it doesn't mean that we're sitting out on the sidelines. It just means that our overweights in terms of fixed income relative to equities, we are leaning into quality, we're leaning into more conservative positioning within our portfolios. What is really going to turn any type of appetite to be long risk assets, it's going to be ultimately the Fed's trajectory. And it's going to be the signs, particularly what we're seeing, jobless claims, not just initial ones, but continuing ones. Those are really the signposts for us in terms of whether we're going to make material changes within our portfolio. And that can happen relatively quickly, given that cumulative impact of all of those indicators that I just mentioned.
Kristen, when people talk about being defensive and having an allocation, perhaps have more heavily weighted to duration, I wonder if that still works, because last year we saw the death of 60-40. This year we see the resurrection of 60-40, maybe, depending on the month. I mean, from your vantage point, are we back to reasserting this sort of ballast of bonds offsetting stocks?
I would hope so. I would hope so. But I think the interesting thing, kind of going back to the common equity markets and then the volatility that we've seen in rates markets, when you look at all of the inflows, we could use the proxy, the ETF inflows that we saw throughout the month of March. When you look at those inflows, and there was about 30 billion of inflows, 28 billion of that was in fixed income. And where was it concentrated? It was concentrated ultra short, and then to a certain extent, a little bit longer in duration. And you really didn't see a lot of activity within that belly of the curve. And so I think right now, when you're looking from a flow perspective, there still is, you know, the number one question that we get is, why don't I just hide out in that short end of the curve in cash and kind of wait for some of this future volatility? So I think some of that we're going to see normalize over the next couple of months, but that volatility that we're seeing on the short end is certainly still there.
Kristen, last question from us. Favorite idea right now? Kristen, what is it that you're advocating for with clients at the moment?
Favorite idea is to play a little bit of defense and actually to take advantage of the low volatility environment that we've seen. That if you are someone who's fully invested, you're not trying to time the market, taking advantage of some of the hedges that are available because of this muted volatility is a way for you to actually stay invested and mitigate some of this volatility that we could see and weather the storm in what could be choppy markets over the next couple of months.
Kristen, thank you. Kristen Bidley there of Citi. Equities right now about 9 minutes into the session on the S&P 500, shaping up as follows. We are just about positive by 1/3 of 1%, a lift in the NASDAQ. Is tech defense, Lisa? We've asked that a few times, haven't we? And the NASDAQ up 0.9 of 1%.
It wasn't, and now it is. It depends on who you ask. I mean, basically, Tom is trying to create a new need for another iPhone.
Triple
so this is basically triple leveraged all iPhone, right? I mean, but this is really the issue, right? What does defensive mean at a time when you have companies that are flush with cash, but they also are interest rate sensitive and have gotten their valuations blown up over the past couple of years?
33 years ago, I went through the same thing. Everybody has these narratives that center around long-term securities theory. You need to be diversified in a well-balanced portfolio. All these themes, with great respect, they got to go out there and do this. And the clients, the trust funds, the institutions go, yeah, but.
How did that work out last year?
There's massive yeah, but.
Well, so far so good in 2023. There is a band setting up behind us here at the IMF Global Headquarters. Jim Bianco of Bianco Research was with us about 20 minutes ago. He said, I didn't get a chance to say it, pinged me a message on the Bloomberg. He said, the drums over your shoulder on stage have a Live Aid look. Can you sing Radio Gaga for us as well? Would you mind?
No, I can't do that. It's not, I could do a Willie Nelson thing, but, you know, I don't think crazy.
Nice.
But this is, you know, seriously, this is Jerome and the dot plots. And what's so great is after the impact of his speech a few days ago, Goolsbee is flying in to play drums.
Not Lady Gaga. Okay. Oh, Bramo. What was that? What was that?
Well, she's a sophisticate on this stuff.
Just take it off.
Come on, thank you. All right, you've got 30 seconds just to sit there.
These guys, they've got to relax.
I want to drown. Please rescue.
They've got to relax. So this is what you get. Goolsbee's playing drums, and you know, I don't know who else is playing.
Jay and the dot plot.
Jay and the dot plot.
I love that. I love that. Raghu Rajan, the former IMF chief economist, former leader of the Indian Central Bank, now of the University of Chicago Booth School, joins us next.
And that's what happens when you push the show into an extra hour. Keeping you up to date with news from around the world with The First Word, I'm Lisa Mateo. Applications for U.S. unemployment benefits rose for the first time in 3 weeks, suggesting some more softening in the labor market. Initial jobless claims increased by 11,000 to 239,000 last week. California accounted for more than 1/3 of the increase. Another missile launch from North Korea. A suspected intercontinental ballistic missile was fired toward waters off Japan's northern island of Hokkaido. That prompted a brief warning for residents to take shelter from the threat. South Korea says it's possible that North Korea may have tested a new type of solid fuel missile. There's a report on the alleged leaker of those U.S. intelligence secrets. According to the Washington Post, it's a young gun enthusiast who worked on a military base and shared the classified documents with a group on Discord. It's an online platform used by gamers. He was known as OG and told the group he spent some time inside a secure facility. Discord says it's cooperating with authorities. JP Morgan is still reacting to last year's nickel crisis. Wall Street's biggest player in metals has cut dozens of base metals clients and slashed bankers' bonuses. The bank was the biggest counterparty of the Chinese company at the center of the nickel short squeeze on the London Metal Exchange. And Apple is accelerating that move beyond China when it comes to manufacturing. Bloomberg's learned that more than 7 billion of iPhones were assembled in India in the last year. Now that's tripling production. Apple now makes 7% of its iPhones in India. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
The top names in business are on Bloomberg.
I think the future of autonomy is real for civil. It's going to take time. Everyone's got to build confidence. We need a certification process that we all have faith and believe in. As you may know, we have an application on an all-electric autonomous airplane we refer to as WISC. There's so much to learn, so much to do, but it is being done.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Really seen evidence at this stage suggesting a contraction in credit.
We have seen a couple of data releases that have shown a certain amount of tightening in credit underwriting standards, as well as in the overall level of credit.
You're being kind, because I think she said she saw no evidence of lending contracting, and you've said we do.
Yeah, absolutely. There is certainly evidence in the data of some contraction in lending and some tightening of lending standard.
Some daylight between Janet Yellen, the US Treasury Secretary, and Tobias Adrian, the IMF Director of Monetary and Capital Markets, earlier on this morning. Some daylight between the administration, the Treasury Secretary, and the International Monetary Fund. I think we've all seen that evidence of lending contracting based on some of the data we got Friday afternoon from the Federal Reserve, Tom, and yet the Treasury Secretary taking a different look on things at the moment, at least.
I see the daylight through the BTMM screen on the Bloomberg. It's real simple. Watch short rates through, in the old school 3-month LIBOR and the rest. What competition that is for flows, and you may not get the drama of a number of weeks and months ago in the banking system, failed marketing plans and that, but you're going to get just a persistent challenge is a whole world gets used to the interest rates we studied decades ago.
Welcome to the program this morning. If you are just tuning in on TV and radio, an extended edition of Bloomberg Surveillance. Allow me to get you up to speed on some of the price action. In the market this morning. The opening bell about 17 minutes ago. Equities with a lift at the moment on the S&P, up 1/3%. Yields a little bit lower by a basis point or two on a 10-year. The standout, a new intraday high for the year on euro dollar. 110.50 plus, now 110.65, positive 6 or 7/10%. 1 hour and 17 minutes ago, we had some data in America showing jobless claims, Tom, a little bit higher than expected. PPI, the biggest drop we've seen on factory gate inflation going back to the beginning of the pandemic, and arguably that's what the Fed is shooting for. And this is the objective, and subsides this morning at least.
And dynamics there with wage growth coming in, and you know, I said a halving, somebody criticized me for that. Maybe it's not a halving, but the disinflation of wages, the disinflation of price, it's tangible.
And so far so good. The equity market likes what it sees. based on the last hour or so.
yeah,
We'll see if this
well,
sticks,
Grandma
because
had that. I
we
mean,
saw some moves yesterday that didn't hold, particularly in the bond market.
Absolutely. And people sort of parsing beneath the surface, and maybe it doesn't look as soft as people originally thought.
Right now, this is a joy. As you well know, there were 142 books written on the crisis of 07, 08, 09, and singularly definitive was fault lines as we face new fault lines now. The author was Raghu Rajan of the University of Chicago Booth School, and his follow-on book, The Third Pillar, was my book of the summer ages ago. The former head of the Indian Central Bank joins us this morning, and we could go for 2 hours, Raghu, and we don't have it because I think you're heading for the airport. So let's get right to it right now. Olivier Blanchard is looking at dynamics of our start and growth. The developed world's looking at this. The emerging market world and their fragilities are looking at it right now. How close are we to an instability of where we need to be versus the growth rate we hope to see?
Well, we have still a economy in the U.S. which is not landing, right? It's chugging along. The first quarter looks pretty good. The problem is more with the medium term. What happens when all the stimulus plays through? What happens when the stimulus from the Inflation Reduction Act plays through? Do we slow down? And what you're seeing in many emerging markets is a lot of damage done by the pandemic, which is also going to hold them back going forward in terms of consumption, for example. The lower middle class, deeply hurt during the pandemic, slowly recovering, but it's going to take time. And of course, we've got all these overheads, such as the tariffs, the deglobalization, the conflicts, the attempt to... So in terms of longer-term growth, it doesn't look good. I think the IMF is exactly right. Longer-term growth looks a lot worse. Of course, where our star settles after that, there are conflicting forces. The IMF says low, Larry Summers says high. My sense is low, that yes, you may get an inflation premium tacked on to the real interest rate that is equilibrium, but it's not going to go back to high levels.
Raghu, Tim from Cupertino emails in. Thanks for watching this morning, Tim. And he says, China and India, you are the #1 expert we have in the world on the dynamics of these two great nations versus a new America. Explain to us how you see 24 months out, Washington, Beijing, and all of India.
Well, I would hope that we don't go down the path we're on between Washington and Beijing. That's the key relationship in the world. That is fracturing. I hope they talk more. They're not. They should. That's important for the rest of the world, because if you have to choose sides, countries will be in a very, very difficult position. Of course, there is hope that some country like India will take up the growth engine from China. That's not going to happen for a long time. India is 1/5 the size of the Chinese economy. Even if India grows at, historic China-like growth rates, which is still a ways away, and it needs to do a lot to get there. India is not going to be a substitute for China. What is important is India do what it does really well. India could be a big exporter of services. You're seeing service exports in India go through the roof. And these are things not just IT exports. These are new forms of services. For example, consulting services being produced from India. It's not just the back office of old. It's new, consultants actually facing clients. It's lawyers facing clients. That's, I think, a mode for the future. That's going to help growth across the world.
Bringing us here to the here and now. Back in 2005, you were the head of the IMF Economics Department, and you warned about a banking crisis. Larry Summers, at the time Treasury Secretary, called you a Luddite. Do you think that we are on the precipice of some sort of financial crisis or significant credit crunch that is underappreciated?
I think we're not over yet. How bad it gets, we will have to see. I think this problem is more systemic. We sort of putting it on a few banks, right? These are the guys who splurged. They didn't do the right thing. The fact is, when you have quantitative easing of the kind we had in the pandemic, the Federal Reserve expanding its balance sheet tremendously, what happens? Well, commercial banks also have to expand their balance sheet. They expand it by issuing uninsured demand deposits. Uninsured demand deposits went up by trillions of dollars during the pandemic, and they haven't come down. So the sources of fragility are there, right? You're bringing down reserves, but these guys still have a lot of demand deposits out there. Now, we've seen that, of course, where those deposits were invested also matters. If they were invested in long-term securities, you're seeing those losses permeate through the balance sheets of the banks. And there will be, problems going forward. The question is, as you pointed out earlier, how does this play out in terms of the credit crunch, which is coming? Are there substitutes? Does private credit, for example, pick up some of the slack from the banking system? That's the big unknown. But accidents, I think we can't say we're over.
Are credit crunches inherently disinflationary?
They are. They are. I mean, they're going to tighten. So you could argue supply side, demand side, right? But I think the net effect is disinflationary typically. So yes, it will do the Fed's job a little for it, but the Fed doesn't know if it's coming. The Fed doesn't know how much. And right now, while the numbers look good, you're still looking at things like services inflation, which is still strong. So the Fed can't relax at this point on the inflationary front, even though, from the credit front, it probably should be a little softer.
You were really moved by your interview with Raghu's colleague, Luigi Zingales. Frame that with a professor from Booth School.
Groupthink, the fate of the Federal Reserve on both monetary policy and on regulation. Do you think that institutions like the one we're in right now this morning, the Federal Reserve, which we talk about often, still suffers from groupthink? And if you do, how on earth are we going to address that?
I think the one thing that seems to be off the table in the discussions is the role monetary policy has played in creating financial fragility, right? We've sort of put that off the table. We don't talk about it at all. And you have to believe that 3 crises in 2 decades, it has to have played some role. And to put it off the table and say, look, it's the private sector, it's the financial sector doing its stuff. They've got bad incentives. Well, that's part of the problem. That's not the entire problem. Now we're saying supervisors are also part of the problem. But what about monetary policy? What about, for example, QE? Wasn't that part of what created the fragility that, in fact, we're seeing now? And that's why we need organizations like the IMF to start talking. They're very hesitant to complain about central banks of the industrial world because those guys have more economists than the IMF sometimes.
I hear you. Unfortunately, we're out of time, and I could talk about this all day, but it's the establishment view still dominates the conversation. And I think that this institution that we're lucky enough to sit in this morning is part of the problem on that front. It needs to make a bigger argument. Raghu and Rajan, always fantastic. Right. Thank you, sir.
Thank you.
Raghu, thank you. Raghu Rajan of the University of Chicago, Booth School. Coming up tomorrow, an extended edition of Bloomberg Surveillance, once again from the IMF. Gerard Cassidy of RBC Capital Markets. Valdis Dombrovskis is going to be joining us from the European Commission. Mohammed Al-Arian with us in Washington. Looking forward to that conversation. From DC, this is...
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
So most actors are thrilled if they have one part like Rocky in their whole career. Yeah. You had another one, Rambo.
Yeah.
Now, Rambo was not something you created, is that right?
No, Rambo was a novel by David Morrell. And I was the 11th choice. Everyone, it was like, I don't know who was next after me because they had gone through everyone. And it passed, including 3 different directors. So this had become sort of a pariah of sorts. The first time we go in there, Rambo was, in the original screenplay, was horrible. He was a psychopath. He killed children, he killed fishermen, this and that. So I said, if I'm gonna get involved with this, I see the character going on beyond this. And they said, what do you want to do? I said, I want to rewrite the screenplay. And I want him to go right to the edge of violence, right to the point where he's being pushed, but he pulls back because, similar to James Dean in East of Eden, he wanted to be accepted back into the family of man.
So if Rambo got in a fight with Rocky, who would win?
Rambo.
Rambo.
Easy.
Because...
Not even a fight. Unless it's in a ring. See, first of all, Rambo is a killer, for real. He's almost a psychopath when that switch flips. Rocky is a good guy. You know, he has mercy. The other one has no mercy.
Suppose somebody is watching and says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. Even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Get your fixed income fix. Watch Bloomberg Real Yield every Friday at 1 p.m. Eastern, right here on Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fiero rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fiero took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fiero continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fiero's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father.